All right. Hey, welcome, guys. I appreciate you guys being here. My name is Hiram Cherez, co-owner of Day Trade Smart. My business partner, Tim Koblin, is the other owner of Day Trade Smart, and he's actually on the session here with me as well. And so I want to welcome you guys to our masterclass, our Super Saturday. The last time we did this, we broke it up into 2 days. This time, we took a lot of that impactful information based on your guys' feedback, and we try to create something that was just 1 day, 6 hours. So there's a lot of stuff that we're going to get through today. But I do want to make sure that we leave time. I try to leave time in there, obviously, to answer questions and have dialogue, which is obviously important to this process. So let's go ahead and get started. Again, thanks for joining us. A little bit about me. I've been doing this for over a decade, again, with my business partner, Tim Koblin. When we first got started in day trading, we had these awesome indicators that were provided to us by our good friend, Kevin Jones Sr., who's actually passed away now. But they were just incredible. Now, Tim had some trading experience prior to me, and so he kind of, showed me the ropes and for the most part trained me. But there were things that we ran into that we didn't know how to solve. Right? There was this lack of information really in the industry in general. It didn't matter how many videos on YouTube we watched or how much we tried to go and try to figure this stuff out ourselves. There was still this gap that we couldn't figure out. And once we figured that out, things became a lot simpler in terms of figuring out how we're supposed to approach the market. And that's essentially how, we decided to create the curriculum and build a day trading program, education program around, this process and these indicators. We've been doing this for a long time, and, we've got thousands of traders now. After a while, we've implemented one-on-one coaching, and then we implemented funding or corporate trading accounts. Now we've got thousands of traders that have gone through our program, are now trading our corporate funds, max funded $100,000, and changing their financial trajectory. So if day trading is something that you've been interested for a long time, you're definitely in the right place. And you'll see really quickly why. And Jason was just asking some questions about that. And I actually had the opportunity. Jason's actually local to us here in Utah, in Lehigh, and he just pointed that out, that he was actually in our office the other day. So that's kind of cool. But we will be showing you guys some things today that are going to allow for you to vet not only us, obviously, but anyone and any setup and any process, because it really does come down to a very specific math and science. So let's go ahead and get to it, guys. First thing we want to start with, of course, is our disclosure. So I'm going to just read through this. Trading and investing is risky and may not be for everyone. All participants recognize that money invested is money at risk and do so for their own free will. Day Trade Smart, its affiliates, subsidiaries, and principals do not suggest or guarantee any outcomes or profits. Performance is individualized and cannot be determined by past performance, whether it is real or theoretical, back-tested, or based on anyone else's performance, as live trading involves a change in the physical and or emotional state of the trader, the market, and broker transactions. All participants recognize and acknowledge that individual performance depends upon individual effort, aptitude, skills, time availability, market conditions, and dedication of each student in the training program. Past performance is not necessarily indicative of future results. Day Trade Smart and its associated companies are not commodities trading agents, brokers, trade callers, tax advisors, financial advisors, or legal advisors, or hold any needed licensing. Day Trade Smart, its participants and moderators are attending for educational purposes only. Any moderators leading trading and learning sessions do not represent company performance. No claims of performance should be made or inferred, personal, group, or otherwise. All participants agree nothing shared is intended to be inferred as performance of an average student. The intention of the information is for instructional purposes only. This education is not preparation to be a licensed broker in the financial industry and does not provide any education, credits of certification, or prepare you to find employment in any area of business. All trading involves high risk. Past performance is not necessarily indicative of future results. There have been no promises, guarantees, or warranties suggested that any training will result in a profit or will not result in a loss. Day Trade Smart associates with companies who solely provide and teach trading and investing materials. All participants acknowledge all tuition fulfillment is handled and delivered by these affiliates. Live and or other trading or investing examples in any promoted trading room or elsewhere are solely exemplary components, and trading examples are strictly incidental to the educational concept being taught. They are not trade recommendations or advice. All right, good. That's a mouthful. All right, so some housekeeping. Please make sure your mic is muted during the event. Only unmute when called upon to participate. Obviously, if you guys have a question, feel free to chat it in, or you know, if we don't get to the chat right away, feel free to just say, you know, really quickly unmute and just, you know, let us know you want to ask a question. That way we can make the most of our time. Okay. Please be sure to remove anything that could be offensive from the view of your webcam. If you do decide to show your webcam, refrain from using inappropriate or offensive language when participating in discussions. If you lose connection to our Zoom meeting, click on the link you initially used to join the session. Once you appear in the waiting room, one of our admins will admit you back into the session. If you're having technical or otherwise issues, or unable to communicate through the event, text our admin at 385-309-0926. If you guys need, let's see, okay, I think we're good. All right, awesome. Okay, so here's what we're going to cover today. So we're going to talk about some introduction to day trading. We're going to cover some technical analysis. We're going to cover a couple of our patterns, hiccup pattern. We're going to talk about myths and facts of day trading. We're going to cover another pattern called a flat top. We're going to review some of these dirty pressure, duckbill patterns, and then we're going to go over alerts. So let's get started. We got a lot to cover today. We're not going to waste your time with unnecessary fillers. If I'm talking too fast or you're unable to understand what's being communicated, please use the chat to let us know. We want you to engage in this event as much as possible so that you can maximize the time we spend today. Ask questions, take notes. The more you engage in the instruction, the more you will get from it. So let's do this. All right, still some people coming in, so I'm going to admit some of these people here. All right. Okay. So we're going to get right into it, guys. Just so you know, this will be uploaded to our YouTube channel if you go to youtube.com/theprovingground. Okay, and I'll give you guys that link later as well. We've got a session going on right now. We've got multiple, but we got a session going on right now every Friday, which is kind of more of like the beginner stuff, but we get more in depth, right? We're going to skim the surface today. Because we want to show you guys this stuff, and obviously we'll provide this recording on YouTube, but we also want to get to the meat and potatoes of things in a very efficient way, right? So we're not going to talk, you know, in a foreign trader language. We're going to just try to use very simple explanations and analogies so that you guys can follow along. And of course, if you have any questions, feel free to chat those in. Okay, so let's talk first about, you know, some of the simple process like buy and sell, right? So when we talk about buy and sell, these are the starts of your trades, entering into a buy or a sell position, right? So this is not like stock, okay? So when you think about stock and you think about the words buy and sell, you think about purchasing a stock down here, you buy it, and then when it gets way up here, then you sell it, right? And you make that profit. So when we talk about buy and sell with day trading, when we buy, it's because we're speculating that the market is going to go up, right? And then once it gets to a certain level that we feel is you know the correct level to release our trade, then we take profit. We take so versus sell it off, we call it take profit, right? And then if we're selling, if the market is going down, then we put in a position to sell or short, right? And then when it reaches a certain level, then we take profit. Okay, so this is different, right? Because with stocks, you need for it to go up, which means you've got to make sure that, you know, I mean, if there's a recession or anything like that, that's going to affect your ability to be profitable in stocks. You got to make sure you pick the correct stock. You know, if a CEO sneezes incorrectly or, you know, is diagnosed with something that can affect the market, especially when they're big stock like say Apple or something, right? That can affect the whole market. Where what we're doing, whether there's a recession or the market is booming and it's going up or it's going down momentarily, whatever it may be, we're able to take advantage in both directions and make, it's of no consequence to us. One is not worth more than the other, in other words. So it's not more advantageous for the most part for us to buy versus sell, right? Or go long versus go short. So just some quick clarification. So you want the market to go up when you buy, right? And you want the market to go down when you sell. This is not like buying and selling stocks. A predetermined price is your stops, right? These are predetermined prices where your trade will close with profit or loss. Take profit where your trade will close with profit if achieved before reaching stop loss, right? And then of course, stop loss is where your trade will close with loss if achieved before reaching your take profit. Now there's a whole math and science to this, guys, and we're going to show you some of that today. So knowing what these parameters should be is the primary key to success in day trading. I'll tell you right now, first let's start with this. There's only one guarantee that anybody can ever make, and you can make to yourself, and only one in day trading, and that is that you will have losers. You will lose trades, right? So get over that right now. It doesn't matter. It doesn't matter if your winners outweigh your losers. Okay, it's like anything else in life. Nothing is absolutely 100%, especially day trading. And if somebody tells you different, they're lying to you. Run the other way. So there's your first, tool in your tool belt to see if somebody, if they pass a sniff test, right? If they're telling you that they win 100% of their trades, or they're full of it, and you need to go the other direction. There's no such thing. Okay. All right. So let's learn about candlesticks really quickly. And some of these things that we're going to teach you are going to be for the purpose of being able to follow along in this process as we're showing you some things, right? So again, if we get to something you're not sure, you can't remember what the breakdown of a candlestick is, feel free to ask about it. We'll re-clarify for you. Okay. So what is a candlestick? A candlestick is a method with which the market measures price movement over time. This is not the only way the market measures price movement over time, but it's the most common way that you'll see the market reflected. And it uses candlestick time frames. So each of these time frames, 1 year, monthly, weekly, daily, 4 hour, 2 hour, 1 hour, 30 minute, 15 minute, 10 minute, 5 minute, and even a 1 minute so let's say, for example, these candlesticks right here are on a 60-minute or a 1 hour chart. Each of these candlesticks would represent 1 hour of movement in the market. Now let's look at what the makeup of the candlestick, right? Components. So a green candle, you have the open. So it opens here, right? When it first starts. So, at 12 o'clock or 1 o'clock or 2 o'clock, right? Top of the hour if it's a 60-minute candle. And then the high. So that's how high it went during that 60 minutes. And it leaves behind it. So at some point, obviously the body of the candle was up there. So the block was up to there. And then as it comes back down during that 60 minutes, it leaves what we call a wick, like a candlestick wick, right? And that's the high. That's how high it went for that 1 hour. The low is the lowest point it went for that 1 hour. Now, what's important to understand is as this candle is forming, if it comes down here below the open, the body of the candle will actually be red, right? So when it came down here, it was red, and the wick was on top of this body, but this would have been a red candle, right? At least momentarily, and it reached that low. That's the lowest point it went for that hour if we're looking at a 1 hour candle. If it's a 1 month candle, then that's how low it went for that month. And then the close. Now the close is the open and close determine what color that candle is going to be, basically, right? So if it opens here and it closes higher than it opened, then it's going to be a green candle. Okay. Now a red candle is just the opposite. A red candle opens at the top, right? and there's the high is the same, how high it went in that 1 hour, how low it went in that time frame, whatever that might be, and then the close. If the close is lower than the open where this candle ended, if it started at 12 o'clock and at 12:59 and 59 seconds it ends, then it ends lower than the open, then it'll be a red candle. Okay, um, so that's the basic makeup of a candlestick. All right. So pips and points. So what does pip mean? Percentage in point, PIP, percentage in point. This is how price is quoted in Forex. The number to the far right, this number, is a micro pip, and that moves up or down in increments of 1. Okay? So if price moved up in this example by 1 increment, the new price would be 1.19565, where right now it's 1.19564. If it moved down 1 increment, the price would be 1.19563. And most day traders will trade pips intraday. So the second to the last digit, which is the 6. Okay, so this micro pip, also called a point, but not to be confused with a point in futures. A micro pip, there's 10 micro pips to each regular pip, but most traders are going to trade on the pip, not the micro pip, and we'll talk about that later as well. Okay. And what does a point mean? So 1/100th of 1 cent. This is how price is quoted in futures. The number of to the far right, the tick, moves up or down in increments of 0.25. So this 75 right here is 3 ticks. 0.75 is 3 ticks. Okay. So if price moved up in this example by 1 increment, the new price would be 27.53, right? Because 27.52.75 plus 25 is 27.53.00. If it moved down 1 increment, the new price would be 27.52.50, right? 27.52.75 minus that 25 would be 27.52.50. Okay. So most day traders will trade ticks intraday. So 0.25 is probably the most common when trading in the futures market. All right. So zero net market. This is really important to understand, guys, because this is not like an inanimate object. This is not like it's robotic and it just always does what it's always done. That's not how it works. There are people, organizations, programs in the background that are pushing the market in one direction or another by intention, by design. Okay, so that's important to understand. So zero net or zero sum market is any market where participants' gain or loss is exactly balanced with the losses and gains of the other participants. If the total gains are added together and the total losses are subtracted, the sum will be 0, hence the name zero sum. So let's look at some examples. Let's use this first example on the left. We have 244 traders buying and 347 traders selling, but the Euro USD is moving up. How is this possible? If we have more traders selling than buying, then how is it that the Euro USD would be moving up, right? Well, let's assume that 347 traders who are selling each have a lot of 1.0. Now, a lot is how you determine what each of your increment of movement is going to be. Okay. Now, in Forex, you can use for most brokers, you can use as little as 0.01 lot, right? In futures, it's contracts, and you could use, say, 1 contract or 2 contracts, but you can't incrementalize. You can't use 1.5 contracts or 1.01 contracts. And that's relevant because if you can't break that down, then and the minimum recommendation for trading a futures account is $25,000 to start, then you trade 1 contract with a $25,000 account until you double it to $50,000, and then you can use 2 contracts, and then you can go to 3 contracts when you get to $75,000. So you can see it might take a lot longer if you can't compound your winnings. Where with Forex, if I traded, say, a 1.0 lot size and I won that trade, let's say for $500, well, then my next, and I'm risking, let's just say, 2% of my account, then my next trade I can increase incrementally, right? 1.03 or 5 or whatever, right? So I could incrementally increase that or 1.1 or whatever it might be, which means I'm going to be able to compound my earnings a lot quicker than I can with any other market, which is why we're going to use Forex as our example today, right? But I want to be clear, we can use this process and the indicators and everything else for just about anything. We trade oil. We have live webinars where we trade oil, gold, silver, Forex, futures, all of it, right, with our members. But we like to start people off with Forex because, first of all, you can get into a Forex account with less. The minimum recommendation is $2,500, which is 10% of 25,000. Right, so $2,500 is the minimum recommendation, but you can realistically get into start a Forex trading account with as little as $100, right? $100. So we like to use that as kind of our jump-off point. Besides that, it's a 24/5 market, which means Sunday at 5 o'clock Eastern until Friday at 5 o'clock Eastern p.m. It is open 24 hours, so it's a 24/5 market, which gives you the ability to be able to trade, right? And not have to, I mean, most people, when they start trading, you have 9 to 5 jobs. And if you've got a 9 to 5, then that means you're not likely to be able to trade maybe in the morning or in the afternoon or when you just get home in the evening. So maybe you're only able to trade at say 7 p.m. at night or 8 p.m. at night after dinner or whatever, right? You have that availability in the Forex market, and you can find volume and liquidity at those times as well. Okay, so we have a lot of 1.0. Now 1.0, if we're looking at a micro pip, let's say, which is that first number, yes, they would, Alan. Then this would be $1 per micro pip or $10 per pip, right? So if it was a 0.01, that would be 10 cents per pip or 1 cent per micro pip. Right, so 1.0 lot size is how many lots you're leveraging when placing that trade. Okay, so if each of these 347 traders have a lot of 1.0 for a total of 347 lots, let's also assume 244 traders who are buying have a lot of 1.5 for a total of 366 lots. Because there are more lots in buy positions, the Euro USD will move up. It can only continue to move up as long as there are traders selling, right? So these lots, the selling traders, are offsetting the buying traders. And if they have, if they're going negative until they hit their stop loss, the buyers are still going to be able to move the market in that direction. So their stop loss will determine, or where they pull their trade out, or what have you, will determine where the market may digress, right? So let's look at it like this. Let's think of it like this. Let's say we have a scale, right? And everybody knows how a scale works. If I have more weight on this scale, on this pan, then that pan would strengthen, right? And this one would weaken. Okay. So if I have more trades, if I have more lots on the buy pan than there are on the sell pan, then the market will go to the long side, right? You'll see more green candles. And if I have more weight on the sell pan than on the buy pan, then the market will start getting red candles, right? So in a zero-sum game, the following actions will make the market move in one direction. If there are more lots selling than buying, the market will move short. There are more lots buying than selling, the market will move long, right? If lots are removed from the buy position, the market can start moving short, right? So just like a scale, right? If we have, let's say we have some weight right here, and there's more weight here than there is there, but we remove some of that weight, then as a result of removing some of that weight, this one strengthens. It may not start giving us red candles, but it could start giving us wick and shadow, right? It might start pulling back a little bit. Or give us, the opposite candle. Just depends on the situation, how much is being released. Same thing for the sell side. If lots are removed from the sell position, the market can start moving long or buy, right? So, for example, if there are 100 lots on the buy pan and 80 lots on the sell pan, the market will move long or up. You'll start getting green candles, right? If at a certain point a number of buy lots take profit, those lots are removed from the buy pan and we would see digression back to the sell side or down movement, right? Now, another way that can trigger the market moving is if stop losses hit, okay? So these lots are also removed from one side, which in turn strengthens the opposite side. Okay, so if the buy pan was getting stronger, and we have these traders that are on the sell pan, as that sell pan gets weaker, they'll hit their stop losses. And when they hit their stop losses, then that weight that was on there goes out of the market, right? It goes off of this pan. It's no longer there. They lost, and it gets awarded to the winners. And as a result, that pan then becomes even lighter, which means the buy pan gets even stronger. So those are a couple of ways that the market will move, right? The best way to look at it is kind of like a scale, right? Which doesn't really help our visually in terms of when it's buying, it's actually moving up, but on a scale, if it's buying, this pan is moving down. So not necessarily the direction it's moving, but which one is strengthening, right? Okay. All right. So let's look at some technical analysis. All right, so we're going to move on to looking at how most of the traders in the world, and if you guys are traders, you guys have or currently use a lot of this stuff, right? The most popular is probably support and resistance. Now, is it just that exclusively? No, but you'll use a mix of a lot of these things. So I'm going to show you these things. I'll give you my personal opinion. You know, they're all right. They're okay. You're going to get 50 to 55% win rates with them. That's just, you know, the fact of the matter. And we'll talk about that here in a little bit. All right. So what is support and resistance? Support and resistance occur when falling or rising prices stop, change direction, and begin to go the opposite direction. Support is often viewed as a floor, right? Which is supporting or holding up price. Resistance is a price level where rising prices stop, hit the ceiling, and change directions and begin to fall. So it's referred to as the ceiling, right? So you have the floor, support, and a ceiling, resistance, and prices will sometimes bounce off of those levels. Now, obviously, there are times where they go through those levels. Now, how do you determine whether or not they're going to go through those levels? Right, that's the hard part for some people in support and resistance. Another caveat to support and resistance is, and I'll show you guys how to draw it, and I'll give you guys some tips on how to draw it. But it's basically the eye of the beholder, right? There's some rules, there's some best practices that you should use when drawing in support and resistance, and we'll go over those here in a moment. But for the most part, if all of us drew support and resistance in the same subset of candles, we would probably have different lines. Who's right? Which one of us would be right? Well, everyone's right. Okay, it's based on the way you see it, and because of that, and because it's never going to be uniform, it's difficult to create a systematic approach, and it's very difficult to replicate because you get caught up on, you know, thinking, well, if say for example, I drew in support and resistance lines, and you're brand new, and you draw in support and resistance lines, and they're different than mine. You're more likely to trust mine than you are your own, which really doesn't make any sense. Yours are just as good as mine. It's not like I've got some secret to drawing better support and resistance lines. And I'll show you kind of what that means here in a moment when we talk about validating support and resistance levels. Okay. Trend. This one's really popular, right? A trend is a tendency for price to move in a particular direction over a period. Trends can be long-term, short-term, upward, downward, or even sideways. Right, so it's okay. Is the market continually moving up? Is it continually moving down? Is it kind of moving sideways in consolidation? What is it doing, right? So when we look at trend, consider this. Trend is only relevant after it's happened. It's already happened. Do you know it's going to continue? What verification do you have that says it's going to continue in that upward trend or downward trend or consolidation, right? Now, you can draw on trend channels and things like that, and I'll show you some of that as well. But for the most part, it's one of those things that is only relevant after it's been after it's already done. So trend is not telling you that it's going to be an uptrend. It's telling you that there is an uptrend. It's not telling you that it's going to change, right? There's a saying, the trend is your friend until the end or until it bends, right? But that's, in my opinion, that's, just an okay friend, right? Because it's not reliable. Friends should be reliable. Okay. Fibonacci. So some backlog on Fibonacci. Fibonacci was born around 1170, most commonly known for authoring the book of calculation. Fibonacci sequence is one of the most famous formulas in mathematics. Thus, day traders use it for their support and resistance line. And we'll go over Fibonacci. Now, Fibonacci we mostly use when day traders use it. It's used for retracement. So let's say that the market has, you're looking at a section of candles and the market's moved down, and now it's moving back up, right? You can use Fibonacci to see what percentage it's moved back up from the move down. So let's say this is like, 50% right here, and the market is now here. That means that it came down and now it's moved back up 50% of that distance, right? And now one thing that I do want to point out really quickly, and we'll go over these Fibonacci percentage levels, these retracement levels. 50% is not actually a Fibonacci level, but it is relevant in day trading. Now, Fibonacci, what he realized was there were these patterns, these sequences that happen in nature, right? Like if you look at a rose, the way the petals grow off the rose are Fibonacci sequence. 23.6% up from the bottom to top of the rose, there's a petal. 38.2%, there's a rose petal. 61.8%, 78.6, 76.4. That's the sequence in which these rose petals will grow off of a rose. If you cut a snail shell in half, each of the chambers are 23.6, 38.2, 61. It's incredible. It really is incredible. But these patterns are found consistently in nature at these very specific percentages, and so that's why Fibonacci is such a big deal. But they're used in retracement levels for trading. Now, again, 50% is not a Fibonacci level, but it is a Fibonacci retracement level when we're talking about day trading. Okay. Price action. This is the most common indicator for execution, right? Price action is movement of a security price plotted over time. Price action forms the basics of all technical analysis of a stock, commodity, or other asset chart. Many short-term traders rely exclusively on price action in the formations and trends extrapolated from it to make trading decisions. So let's go over some of this, okay? Let's look at support and resistance, trend, Fibonacci, and price action, okay? And we'll take them one at a time here. So this is a chart, a candlestick chart, right? And you can see that when one candle ends right here, this green candle ended right here, right? Because we know it starts here and it's green because it ended higher than it started. And then where it ended, the next candle starts. And if it started there and it ends lower, then it's red. And this candle went to that one and it started there. And because the where it ended is lower than where it started, it's red. This candle started here because it's higher than where it started, it's green. There, ended, so it's red. There, ended, so it's red. There, just a little bit there. There, ended, red. Red, started there, ended higher, so it's green. Started there, ended higher, so it's green, right? And while these candles are forming, you can see that it went up to here and then came down to there and then ended right there. So it started there. Let me erase some of that. Now it's getting all jumbled. So it started here, and at some point it went even up to here and then came back down. At some point went down to there and then came back up and ended right there and went on to the next candle, and so on and so forth. That's how a candlestick moves. This is a 60-minute chart, so each of these candlesticks are worth 60 minutes of data. Really quickly, I want to show you how to count pips, okay? And on my YouTube channel, guys, let me just show this to you real quick. And I don't care if you subscribe, you definitely should, but I don't really care if you do, which I've been told I shouldn't say. You should ask for subscribers. I'm not going to beg. You can subscribe if you want. And subscribe just means you follow it, right? That you don't pay for it. You just follow. It's just following the page. So youtube.com/the proving ground. Okay. So if you go here, you'll see a video. This is, you can watch these. These are the what is day trading for beginners. Some of the stuff that we're covering today is in these videos, and also in more in depth as well. But there is a video that is called, where is it? Maybe I don't have it on here yet. Well, I'll add it on here. So there's a video in here that's called MetaTrader 4. Let me tell you exactly what it's called, because I want to give this to you guys so you guys can learn. If you've never used MetaTrader 4, this is going to show you how to use this program to be able to place trades, right? And how to count pips, how to determine where your stop loss and take profit are, all that stuff. So I'll get that. Let's see. I want to get it right now. MT4 tutorial. Here we go. Okay. So let's see. Yeah, it's made public. Why is it? Okay, so it's just called MT4 tutorial. Okay. So on that page, it should be, I never look at this side of my page. So I'm like, where is this video? Let's see, videos. Yeah, it's in there somewhere. I don't know. Maybe it's one of the playlists. But anyway, I'll make sure that it's on there for you guys so that you guys can watch that MT4 tutorial. Okay. All right. So in the MT4 tutorial, we talk about pips. So let's look at this price right here. And just to give you guys, just so you guys can follow along for today. The price that the current market price for this, and this was back 5/8/2020. So I just went back somewhere random. Actually, let's just do it again just so you guys know I actually went back somewhere random. I'm just going to pull forward. This is where the price ended on Friday, 1.38675. So you guys can go and verify that. And then I'm just going to click back. I don't know. I'm just going to do, let's just do, I don't know, 5 clicks. 1, 2, 3, 4, 5. There we go. So 3/5/2021 is where we find ourselves. You guys can see the date up here. And the time 1900, and that's UTC. Okay. So the price is 1.38393. This is the Great Britain pound versus US dollar. 1.38393. Okay, so 1.38393. This is the pip. This is the micro pip. Okay, here's the quickest and easiest way to count your take profit and stop loss. Okay, if we're buying, let's say we want the market to go up by 5 pips, so this 5 times, right, up, then we want to add 5 pips to our entry. So let's say we entered at this price, 1.38393. Then let's look at just these 3 middle numbers, 839, right? And don't be shy, use a calculator if you want to. I used to use one even if it was simple math. Okay, so we want to take profit when the market moves 5 pips up. Okay, and let's just say we'll use 5 pips down for a stop loss. So 839, you guys already know the answer, plus 5 is 844, right? So 844. And then just bring up that last 3, bring up this 3, bring up this 1, 1.38443. There you go. Right? Now, let's say that's our take profit because we're in a buy. If it's a stop loss, if we're setting our stop loss, then 839 minus 5, right? Let's do a different number. Let's do minus, let's just do minus 10, right? Let's say we're a 2-to-1 ratio, so we're minusing 10 and 5. We like using that as an example. So 839 minus 10, which is 829, right? So 839 minus 10, 829. So put that number right there, 829. And then bring down that 3. Bring down that 3.1. So 1.38293. There you go. You've got your stop loss and your take profit. It's the easiest way to count pips. Why do we use all three of these numbers? Well, what if this number is, let's say this price is actually 897, right? 1.3897. Okay. If that is 1.3897, well, to subtract from that would be okay, right? Because we can go 897 minus 10 would be 887. But if we add 5 to 7, what do we get? 12, right? So if we just did these two, that would be okay, right? 97 plus 12 is going to be 100, or 109, right? Well, what are we going to do with that other number? So if we use all three of these, we're likely to stay within, carrying over to that next number. So 897, and we're adding 5. So what's 800? If we add 5 to 7, it's just 12. So then we got to figure out what to do with the 9. And because it's a 9, we got to figure out what to do with the 8. Where if we just always consider those three numbers, we'll be safe in being able to add or subtract from that number. So 897 plus 5 is going to be what? 902, right? So 897 plus 5 is 902. So then this number changes to a 9, this number changes to a 0, this number changes to a 2, carry up to 3, carry up to 3.1, 1.39023. And writing it out, by the way, when you first start helps. Writing it out on a piece of paper or using a calculator helps. It really does. Now, not to overcomplicate it, but let's look really quickly at the GBP JPY. So I want to show you this price format is different, right? It is 149.936, 149.936. The point is in a different place. We're still going to use these three middle numbers, 993. 993 plus 5 is going to be 998, right? 993 minus 10 is going to be 983. And then we would just put in, so on this one, we would obviously just go 998, right? Carry up that decimal, put in the 6, put in the 4, put in the 1, 149.986, right? And then minus 10, 149.836, right? 993 minus 10, 983. So 9.83. Bring down that 6. Bring down that 4. 149.836. There you go. All right. That video is going to show you guys that as well. So definitely go and watch that video, download it, whatever you want. It's yours. Okay. I just wanted to show you guys that because we're going to be looking at measurements and stuff. All right, first thing, support and resistance. Okay, so first thing, let's say that this is the live market. Matter of fact, let's just replay it if it was the live market. So I'm going to replay this as if we're looking at a live indication. Oh, well, that's okay. I meant to use the GBP/USD, but we'll use this one. That's fine. Wait for that to load. I've got this. These charts go all the way. Some of these charts go all the way back to like 2003 or 1993, even when the Forex market started becoming more online with ECNs, electronic communication networks, allowing for day traders to go online and start trading. Okay. So watch, and this is actually good because you'll be able to see, if you've never seen before, how a candle kind of forms, right? Sometimes it goes down, sometimes it goes up, and then it leaves kind of those traces, the wicks and shadows, right? So we'll watch that as it's moving. Now, let's say that we're going to analyze this and use support and resistance to determine where our ceiling and where our floor is, right? First thing we want to do, and I would highly recommend having some type of charting software that you use. You can do this in, with a lot of times with brokers, they'll provide a charting software or even just a charting platform where you can place trades and also draw lines, but nothing compares to having like a solid charting software with all the tools you need. It just makes things really nice and neat. But I'm going to use this line. It's pretty basic, horizontal line. And I'm going to draw in first my current market price. I'm just going to change that to black. So that's my current market price. That's, obviously it's going to move from where it is, right, as it's forming, but that's close, just to be close to wherever the market currently is. Now, here's your rules. You want to write these down. You want at least 2 lines, on a 60-minute chart, you want at least 2 lines above your current market, your current market price, and at least two to three lines above, and at least 2 to 3 lines below your current market price, okay, for ceiling and floors. And then you want those lines to be separated by, on a 60-minute chart, by 10 to 30 pips, somewhere within there. Spirit of the law, guys, not letter of the law. So it's like, well, what if it's 31 or 35 pips? It's fine, right? It's not an exact, just somewhere within that range, 10 to 30 pips of separation, okay? And that's going to cover you if you want to take a scalp, or if you want to take, maybe just a nice little stride on a 60-minute chart, okay? So if you're using a larger chart, then you're going to scale up how those lines are separated, but still have at least 2 to 3 lines above and below, at least 2 to 3 lines above and below your current market price. So that's our current market price. Now, when we draw in resistance, which is on top, our ceiling, we're going to look for areas where the market has obviously come up and pushed price back down, but not just a little bit. We want at least that 10 to 30 pips, right? And so we can see that happened there and there, but we don't want just 1 point of validation. We want at least 2 to 3 points where at that same level, the market came up and pushed the market back down. And so at least 2 to 3 points on that same level. So all we can see are the candles that are here, right? So if I tighten this up, then I can start seeing more candles, right? Okay. So if I take this line and I draw it right there, I can see that got pretty close, but not quite. That's probably going to be closer to this level right here, right? There we go. So let's start there. I'm going to erase this one for now. Okay, so I can see right here that the market came up and rejected price right there, and right here, and right here. Okay, it didn't reject it right there, but that happens. You're never going to find a level that always rejects price. It's at some point going to go through it and back through it, so, but we can obviously see here that the market rejected price there, and there, and it was significant, right? Boom, look at that big drop, boom, right there, right? So we're going to use that one as our first level of resistance, our ceiling. Now we want another one, right? We want at least 2 to 3 of those levels. That one is about 48.6, so we could probably put another level right in the middle of that, right? So right here, let's say right there. So that actually works twofold, because we can see the market came up, rejected price there. It came up, down, rejected, and came back up, and then went through it, came up, rejected it there, and came down. Over here, we can see that this wick touched it and pulled back. Those got pretty close. That one touched it, came back, right? And then again, came back, and then broke through. Okay, so we can see we've got multiple, at least 2 to 3 areas where we can verify that level rejected price. Okay, now we've got this other level up here, and we don't have any other point of validation. So let's go back. I'm going to make these candles larger. Let's go back a little further until we can find a place where those levels can be validated. Man, oh man. Let's see how far back we got to go. Do we hit some? Where? Let's see. Oh, yeah, I guess we did hit some new highs. Look at that. We've been on some new highs for a minute here. So let's go back. Might have to go back some ways here. Don't let anybody ever tell you the market always returns. I mean, it might, but you don't want to be sitting in trade that long, right? I mean, look at that. That's like we're now back to 2018 and we barely found that level. That's crazy, right? Okay. Look at that. But back in 2018, that validates that level that we were just looking at, right? That we hadn't hit. So we're looking at 2021 today. We hadn't hit that level right there since 2018. This is back, yeah, we're going to go into April. So, yeah, 3 years just about, right? Since we've been at this level. And you can see right there that it validates it, right? We got market came up right here and bounced, pushed price back down. Didn't really touch right there. It did pop through right there, but then came back. And then right here, kept that price, right? Okay. So that level is validated. Good. Let's go back to where we were over here. There we go. That's better. Okay. So we know that that level is validated. So now we got 3 lines above our current market price, and they're about 26, 32, and to the current market price is 23. So that's good. They're within that 10 to 30 pips of separation, right? Okay, now we need our floor, right? Our support. So let's draw in some support. I'm going to tighten this up a little bit. And we can see that we've got a level right where we are, actually, right there. But right here looks to be a more valid level. Let's see. I'm going to bring in some more candles. Oh yeah, we're on some new highs. Okay. So let's go here. Yeah, that'll work. Okay. So we can see right here, the market came up all the way up there and then bounced. So that's good. And then broke through right there, right here, right? It popped through a little bit, but it came up, pushed the market back down. Right here, kind of stuttered a little bit, and then went through and then came down and used it and then worked as support right there. Let's find some more levels on that line just to validate it a little more that give us support versus, because we got resistance as the market came up to it, but we want to find where the market came down to it and use it as support, because we may have to make some adjustments either up or down just to play it safe. So again, we'll probably have to go all the way back to those 2018 levels. Actually, that works pretty well. Look at that. Just a little bit lower. Adjust. Right there. Let me stretch this out so you guys can see it a little better. So right there, we can see it came up and touched the high of that and then pushed it back down, right? Back here, where'd it go? Back here, we can see it came up, boom, hit those highs, pushed it back down. It did pop through there and then came back, but we've got our validation, right? So sometimes we're going to validate with wick and shadow, and other times we're going to validate with the actual body of the candlestick. But right there, we have the validation we need. Good. And then we're going to, since we're here and we know that we don't have very many lines where we just came from, let's see if we can draw on some other lines while we're here. So we've got some levels. That might be a little too far. I'm going to draw that one. And there's probably something in here. I'm going to draw that one. Make these blue just so we know we got to kind of work with these a little bit. Okay. So if I go forward, that one got pretty close to validation right there. So I'm going to draw this one right here just in case we need to bring that one down, make that blue. Nothing, nothing, nothing. And then finally we start coming up. Okay, good. So right there, that works, right? We hit that. We wanted support though, so let's see. So that line we validated, that was good. This line, there we go, boom, down, pushes up, works as resistance as well, right there. Got close there, but no cigar, but that's good enough, right? We got enough points of validation right there. So that's good enough. We'll use that. Okay. And then, so let's change that back to actually erase right there would give us a little more validation because we can sandwich that range. That seemed to keep price pretty consistently. You see that? Kind of bounced in there quite a bit, and it's validated right there. So we'll use that. And then this line right here, we can probably leave right where it is, maybe a minor adjustment to right there. And yeah, that works, right? Look at this. So resistance right there, and then support right here, and right here, and right here. Came down, then up, down, then up. Good. So that one works too. Whoops. Okay. And then this last one, since we drew it, let me erase that. Oh, no, don't do that. We've got a level right there, boom, went up, and then right there as well. So there's some validation right there. Let's measure these. 36, it's like 34, that's good. 20, that's good. 23, that's good. To there is like 50, right? Because this is our current market price. So, but that's actually kind of on a level, right? So let's actually remove our current market price now that we've got levels above and below it, and then just draw a level in there, right? And right there seems to work pretty well. We can see that we've got resistance as it came up and support as it came down right there. And then over here, we've got support and then broke through and then came back. Yeah, that works. Okay. So we've got enough validation right there. Okay. So now we've got our levels of support and resistance. We used our rules, right? Which was we wanted to see at least 2 to 3 lines above our level and at least 2 to 3 lines below our level, and then be separated by at least 10 to 30 pips. So here, 24, there, 31, there, 24, there, 31, there, 24, there, 21, there, 36 or 35, whatever. Okay, so we've got some levels, right? All right. What was next? Trend. Okay, so let's tighten this up and look at, there's a couple ways we can look at trend. But I want somebody to sound off, okay? Even if, and maybe somebody that has no experience in day trading, because this is easy. Which direction is this trending? Would you say it's trending up or it's trending down? Just based on those words, trend up, trend down. Which way would you think this is trending?
Up.
Up, right? You don't have to be a rocket scientist to see that. It's trending up. Now, in spite of the fact that it's trending up, we still have down movement, right? Which is another issue that I have with trends, by the way, is that just because it's uptrending doesn't mean you can't take down trends. Now, this is a longer term trend, right? This is a long-term trend. It's definitely biased in one direction, but even within a long-term trend, you can still get downtrends, smaller, shorter-term downtrends. Like right here, this whole thing is an uptrend, but right here we can see we had a minor downtrend. Right here we can see minor downtrend. This is not. This is more consolidation, sideways movement, right? So a trend works like this: a little bit of up, down, a little bit of up, down, a little bit of up, and your peaks get progressively higher and higher. Your valleys get progressively higher and higher. So the lowest point, so here we had down, right? And then a peak that's higher than the previous peak. And then a valley that's higher than the previous valley, right? And then it kind of consolidated, valley, peak, valley, peak. So the peaks become higher and higher, and the valleys become higher and higher, right? So there's an uptrend, okay? Now, a downtrend is just the opposite, right? You've got a peak, valley, peak, valley, peak, valley, and your peaks become lower and lower, right? And your valleys become lower and lower. And that's a downtrend. Sideways is kind of how it sounds: a little bit up, a little bit down, a little bit up, a little bit down, right? So peaks and valleys can be like higher, lower, but for the most part, it just kind of stays in one range, right? Sideways. So let's look at some examples of that. Obviously, this is a long-term up, and let's just use something cheeky. Let's just say parallel raise. Let's do even worse than that. Let's go linear regression. So we'll start here and just draw in linear regression. Obviously, we can see that kind of fell, most of that fell within that linear regression channel, right? If we wanted to freehand it, we can go from here up, nope, from here, nope, from there. Yeah, that's going to be better. Right there. And then right there. Okay. So this is just what we call an outlier. It just market shot up for a bit and then fell back into the channel. But you see this kind of channeled right within there. You had a high right there, it came back down to about 50%, and then the low came back up to about 50%, rode that 50%. So you can see that's an up channel right there, right? Uptrend. That's more of a long term. I just wanted to find, so if I try to draw from down here, you can see that it would bow out that channel way out here, and the price has kind of moved all the way up there and then maybe 50% there. So it's a little too wide. So I just picked an area where I can channel it that would be consistent in a smaller time zone, in a smaller area, right? You can also use, and we haven't talked about Fibonacci yet, but we could even use Fibonacci levels within that: 23.6, 38.2, 50, 61.8, 78.6, 76.4. And we can see how sometimes it'll stutter at those fib levels. But that 50%, look at how much action is on that 50% level. A lot of action right there on that 50% level. All right, I'm going to take those off just because it gives me a headache to see all those lines. Okay. Okay, so we've got a trend up right there, right? And that's long term. We can even look at a shorter term trend right here. So we could go from here to there, and that follows right alongside, right? And there to there. There you go. So let's look at that a little. Let's take this one off just for a moment.
Hi, Jalen, where you going?
Okay. All right. And then we can see that we've got within that channel, right? We have valley, peak, valley, higher than the previous valley, right? Peak, valley, higher than the previous valley. So what is this then? Consolidation, right? That's kind of sideways. And we can see if we sandwich that between, let's just say, this level right here. Oh, wrong tool. Like this level right here. And this level right here. Kind of had just that sideways movement for hours and hours, right? And this can happen long term as well, but just wanted to give you kind of an example of some more sideways movement. So it didn't really move out of that range, right? From about here to there until it broke out is about 1 day and 8 hours. So it just kind of went a little bit sideways and then finally started to make its move up. Okay. All right. So now we've got our trend and we decided it's up, our trend, uptrend. And now let's look at Fibonacci. Did we skip anything? I don't think so. Let's just make sure. Nope, we're on Fibonacci. Okay. All right. So I'm going to use this retracement tool. And because we are right here after this move up and then back down, we can look at, and we can look at Fibonacci a number of ways, but let's look at what the retracement is from here to there, right? So we came from up here all the way down here, and now we're moving back up, right? So we've retraced, and let's go over these Fibonacci levels. There's 23.6% retracement. There's 38.2% retracement, 50% retracement, 61.8% retracement, 76.4 and 78.6% retracement, and then obviously 100% retracement. So if it gets back to this line, then it's retraced 100% of the move from here back up, right? So what percentage have we moved back up after moving down here, right? That's what we could use this Fibonacci sequence for, okay? So we've moved up, it came down and then it came up 23.6%, kind of bounced off a little bit, but then the next candle broke through it. And then now we're going up to this level right here, which is 38.2%. The most common levels to be hit with the Fibonacci sequence is 23.6, 50, and 61.8. 38.2 is I would say fourth on that. 23.6 and 50 are going to be the most common. 61.8 third to that. 38.2 is going to be fourth on that list. 76.4 and 78.6 are going to be last on that list. 23.6% is going to be number one, though. That's usually the number one level that's hit in terms of retracement. Okay, so we've retraced now going on 38.2%. We haven't touched it yet. So we know we could potentially hit that, but we know that 50% is a bigger retracement level. But here's the kicker, guys. I decided that I was going to draw the Fibonacci sequence from right here to right here. So what's to say that these levels, these retracement levels, are valid? Well, I'm the only person that can validate that. No one else can, right? So it's got to be something that you trust in, basically, that you trust your process and where you start those lines, where you draw them, and how you use that tool, right? If you learned how to do what, use Fibonacci sequence, and you used it right now as we're looking at the same sequence of candlesticks, however you're using it is right as well. So just because I may be using it longer or may have used it longer or be more familiar with it doesn't mean that yours is wrong, right? And that's the tricky part of this whole thing. And by the way, again, this is not stuff that I really jive with. This is not how I trade. This is not how I would recommend you trading professionally. But you can, and people do, and they make money in the market, make millions. But to get to that point is a whole process, and we're going to talk about that, and we'll talk about that later on. But okay, so now we know that we've got our Fibonacci in here, and we've got about 18, 19 pips before we get to our 50% level, and we've got about, we're right on our support level, and below that would be the 23.6% retracement level at about 18 pips, and then our other level at about 37 pips from our current, from where the market is now after drawing our lines, right? Okay, so now let's look at price action. All right, so let's go back here and let's look at some examples of price action. Okay, price action is, so let's look at an indication for buy for price action. If I have a high, let's look at this one right here. So if I have a high that is higher, so this high on this candle is higher than the high on that candle, and a low that is higher than the low of the previous candle, then that would be a buy indication for price action. If I have a low that is lower than the previous, or sorry, a high that is lower than the previous high, and let me get another example here because that one doesn't follow. So if I have a high that is lower than the previous high and a low that is lower than the previous low, so lower high, lower low, that's an indication to sell, okay? If I have a candlestick that is neither higher nor lower, so the high is lower and the low is higher, then it's a consolidation. It usually means sideways. If I have a candle that has a, let me find one. Let's see. We want a candle that has a higher high and a lower low. Oh, let's see. Here we go. So right here, if I have a candle that has a high that is higher than the previous and a low that is also lower than the previous, and it's red, then that's an indication short. If I have one that has a high higher than the previous and a low lower than the previous, and it's green, then it's an indication long. They're called reversal candles, right? Okay, so let's break this down really quickly. A candle with a high, right, higher than the previous, and a low also higher than the previous is a buy. If I have a high that is lower than the previous high and a low that is lower than the previous low, then I have a sell indication. Okay, if I have a high that is higher than the previous and a low that is lower than the previous, okay, and it's green candle, then it's a buy. If I have the same thing and it's a red candle, then it's a sell. Okay. And if I have a candle that is the high is lower than the previous and a low that is higher than the previous, then I have a consolidation candle, and that's indication of sideways. Okay. If you guys want to learn price action, you can look that garbage up anywhere. So I'm not going to spend any more time on it than I need to. Okay. So let's go to our current candle. What do we have? Somebody let me know what we have right here. Do we have a high, and this candle's not over, it's not over for another 28 minutes. Do we have a high that is higher than the previous and a low that is higher than the previous, or high, low? What do we have? Is this a buy indication, a sell indication if it stayed like that? Don't be shy. Somebody let me know. Take a guess. Come on, someone. It's a buy indication, right? We have a high that's higher than the previous high and a low that's higher than the previous low. Higher high, higher low, buy. Okay. So here's another rule for you. Write this down. If we are going to take this trade wherever we enter, if it is with the trend, which means if we're buying, because that's what the trend is, we said it's up, then we are going to take 50% of the distance, okay, between our entry and our next level of resistance. Okay. If we were selling in a downtrend, then it would be 50% of the distance between our entry and our support level, right? Now, 50% of the distance between our wherever we enter and our next level of resistance. So if this is 20 pips with the uptrend, then we would try to take 10 pips of that. Now this setup, support resistance trend wins, goes in a favorable direction 50 to 55% of the time. Okay, that's a fact. 50 to 55%. So let's say 50% because it's just an easier number to work with. Okay, I have to set, if let's say I'm going to take a 10 pip take profit, then I cannot have a stop loss that is greater or equal to 10 pips. I have to have a stop loss that is less than 10 pips. Okay, so let's say 5 pips. I have to have a stop loss that is less than my take profit. Why? This is day trading. This is the magic in day trading. Because my risk to reward ratio cannot exceed, actually has to be less than a 1-to-1. Okay, so this is risk to it's called risk to reward. Okay, so because it's called risk to reward, the first number is our risk. We're risking 5 pips to get 10 pips. Our reward is 10 pips. Okay, 5 pip risk, 10 pip reward would be a 1-to-2 ratio. Okay, 1-to-2. Our reward is twice the size of our risk. It's not because this is preferable that we do this. I mean, it is preferable, but it's not because it's preferable that we do it, that we use a risk to reward where we're risking less than our reward. It's because it is necessary if we used a 1-to-1, okay, hang with me here. I had a 5 pip stop loss and a 5 pip take profit, and I took 10 trades, okay? So at 50% win rate, I would win 5 of those 10 trades. For how many pips? 5 pip take profit. What's 5 times 5? 25. And then I would lose 5 of those for the same, right? Negative 25. What is my profit? It's not 0. My profit is not 0, by the way. My profit is less than 0 because each trade that you put in has a commission usually. Usually it's nominal. Most brokers for a 1.0 lot size is going to cost you about $2 to $4, sometimes even less. So if I put in 10 trades at $2 per trade, then I've used $20. I put in 10 trades and I broke even on those 10 trades, I lost $20. Okay? Even if I broke even and made up that $20 somehow, is the idea, listen to me, is the idea to day trading to break even or to make a few pennies? Are you guys here? Are you guys wanting to? Are you interested in day trading to make a few pennies? Or are you trying to change your financial trajectory? Are you trying to stack your retirement, replace, supplement your income, right? Build wealth. Are you trying to do something significant with it, or is it just an expensive hobby? If it's an expensive hobby, you're in the wrong place. Log out, go somewhere else. I only teach people that are interested in making money with day trading. That's who should be here. If that's not you, you're in the wrong place. Sorry, wrong class. That's okay. It's not that I don't like you. I just don't want to waste your time. Please don't waste mine. We're not about making pennies. Okay? That what I'm showing you right there is a foundation of day trading, and how to figure out those numbers. Good luck figuring that out. Go ahead. This is the same struggle that Tim and I had when we first started. There's no information out there. Nobody's telling us how to back test, how to figure out risk reward, risk percentage, probability. They say, oh, here's your money management. But they're not really teaching you how to figure it out, nor is it even valid money management. And we're going to talk about that later. I'm going to show you guys some stuff. And this is fact. You can look this stuff up. You don't have to, I don't want you to just take my word for any of this. All right. So if we're winning this trade at 50 to 55% of the time and it's price action, then we're only going to use, we're going to have to use a 1-to-2 ratio. So whatever our take profit is, half of that is going to be what we're going to risk for our stop loss, which means we have to be able to reach this up here before we go half that distance against that position. Okay. And we'll win that about 50 to 55% of the time. Okay. All right. So we have 20 minutes before we could enter this trade. Fortunately, we're looking at a replay and I get to just fast forward. So let's go fast. Let's go forward. We've already determined that our trend is up. We've determined where our levels of support and resistance are. We even looked at Fibonacci, and our line of 50% Fibonacci is actually right where one of our resistance levels are. So that's going to be where we're going to aim. That's going to be where we're going to shoot for. Okay. If this stays with a higher high and a higher low, then we're going to be looking to take a buy because that's our indication to buy, right? Okay. And we're going to take 50% of the distance of wherever that candle ends to our next level of resistance. Okay. So let's go speed this up. 16:15 on the upper left, you can see in black the time remaining. 7, 6, 5, 4, 3, 2, 1. Okay. So right now we've got some room, right? The first thing we're going to do when this candle ends, if it stays this way, right, unless something dramatic happens at the end there in 2 minutes, we are going to first just get into the trade. We're not going to set our stop loss and take profit until after we're in the trade. We want to get in as soon as that new candle rolls out, right? So we got 2, 1, 120. 5, 4, 3, 2, 1, 15 seconds. Okay. 15 seconds. We've got our finger on the trigger. ready to press the buy button. I'm just going to draw a line to represent where we would have pressed the buy button. And as soon as that new candle comes out in 4 seconds, right there, boom. All right, this is our buy. We are now in a buy. Our entry, 149.936. 149.936. Let's look at these three middle numbers. 993, right? Okay, let's measure. What's our take profit? From there to there is going to be about 10 pips. So what is going to be our take profit? If we have 10 pips from our entry to our next level of resistance, it's actually about 12 pips. So let's say 6. So we're going to take half of that, right? 50%, because we're with trend, and we're going to take 50%. If we were going against trend, we'd only take 25%. Okay? So 149.936, and we're going to take 6 pips. So 993 plus 6 is what? 999, right? 993. So 149.996 is our take profit. Now our stop loss, if we're only going for 6 pips here, then our stop loss has to be 3 pips, right? 1-to-2 ratio, it has to be. Because if we move it out and we only win 50 to 55% of our trades, yes, maybe we start winning more of those trades, right? But what happens? What happens is you lose money, okay? Let's say that you say, well, I'm just going to move my stop loss further because I keep on hitting it and I want to win more often. So let's say now you're winning 65% of your trades, right? You're winning 65% of your trades now because you decided to move your stop loss out. And now instead of taking a 6 pip profit and a 3 pip stop loss, you're using a 6 pip profit and a 12 pip stop loss. But you've increased your win percentage by 15%, right? Well, if you have 35% losing at 12 and 65% losing at 6, you lose money, right? So you can't use a 2-to-1 with 65%. Matter of fact, you can't start using a 2-to-1 until you hit at least 70% win. Your stop loss can't be twice as big as your take profit unless you're winning 70% of your trades or more. It's not because I said so. It's because math says so, right? It's you either make profit or you make loss. It's not because Hiram said so. Okay? So where is our take profit then, right? 149.936 or 149.996. Let's draw on that line. We would obviously have been putting this trade in our brokerage account, pressing the buy button and sell button, and then setting those stop losses and take profits like I told you that video will show you how to do. So that blue line represents our take profit. This black line right here will represent our entry. And then the red line, which I'll draw here in a moment, will represent our stop loss. So if I have a 6 pip take profit and I have to use a 1-to-2 ratio, then I have to have a 3 pip stop loss. So 149.936. So my stop loss would be 149.906. 149.906. I'll make that line red. So moral of the story, we want to just hit that blue line before we hit that red line, right? We're pretty close to that red line. Let's replay this. Okay, let's fast forward a little bit. Come on, there we go. Good. Made a successful trade. Awesome. Okay. So that's your analysis, right? I mean, the other thing that you would obviously do is check announcements. We didn't really talk about announcements. We're not going to, but I'll tell you right now, stay away from them. Other people will tell you to trade announcements. It's good for liquidity. To stay away from announcements. It doesn't matter what the announcement is. The market doesn't have to do based on what the announcement says. A lot of times it will, but that's the trick. And by the way, the big players, hedge fund managers, big banks, they count on you doing whatever trading based on how the announcement is released. So if they know a whole bunch of traders are going to go long on gold, then they know they can short gold, right? Because it's a zero-sum market. In order for them to short gold, they have to have the counterbalance. Well, they've got billions and trillions, and collectively, right, we can put in large, collectively, if all of us, went the same direction, then that would be enough for them to be able to put in a big trade in the opposite direction, and you get taken to the cleaners. That is not hyperbole. That is not some conspiracy theory. That is the way the market works. Don't let anybody tell you different. Look it up, right? Unless you know what you're looking for, or that you should look for something, you wouldn't find it. But now you know. That's how it works. The big players in this game bank on you just selling on resistance and buying on support and try to trade with the trend. All they're doing is waiting for a whole bunch of people to do the same thing so that they can do the opposite. That they hide their biggest moves during announcements. We never trade announcements. You should never trade announcements. The worst thing that can happen to you, I'll tell you right now, is you do something that you're not supposed to do and it works. And it works out. You reward yourself for pissing on the carpet. So what do? You do it again and again until it costs you, until it wipes you out. And it will eventually. Those things move so quick sometimes that even if you have a stop loss, and it may jump right past it and take you out somewhere else. It's tricky business. Stay away from them. Stay away from announcements. Since we're talking about Forex, a good place to check for announcements is Forex Factory, forexfactory.com. If there's an announcement happening, 30 minutes before the announcement, stay out of the market, and at least 30 minutes after the announcement, stay out of the market. Even if it's not relevant to the currency pair that you're trading, until you learn how to read those kinds of things, the announcements, and figure out which ones are going to be more impactful or less impactful, just stay out of all of them. But some, like for example, FOMC this on Wednesday, for those of you that don't know, the Federal Open Market Committee is the Feds, right? They set interest rates. So Jerome Powell, who's the Fed chair, spoke on Wednesday afternoon about the projections for interest rate increases. And so the market reacted, and most currency pairs reacted, even though not all currency pairs are euro or are US dollar, right? There's Great Britain pound versus Japanese yen. Neither of those are US dollar, but because the US dollar and the European Union, the euro, represent so much of that pie, when a major announcement happens in one of those countries, it affects the whole market, not just the Forex market, but especially the Forex market. Okay, so let's move on. All right, do you guys have any questions about that? Yes, Jason, I can. So Jason's asking if I can explain risk reward. And we will go over that again later, but I want to just touch on it really quickly. It's just simple math. When you back test, and there is a specific way to back test, and we'll talk about that later. When you back test, what your outcome is going to be is a win percentage at a stop loss and take profit. Okay, at a specific stop loss and take profit. Okay, so let's say you've back tested and you find that you can win 70% of your trades if you used a 10 pip stop loss and a 10 pip take profit. Okay, so you have 7, and let's say you take 10 trades. Okay, you took 10 trades And you won how many of them? At 70%, you won 7 of them. And you took 10 pips per trade. So you have 70 pips. You lost 3 of them for 10 pips. So you have negative 30. Okay? 70 minus 30 is 40. So you have 40 net pips. All right? Now, what if this number was 30? This is a 3-to-1 ratio. Okay? Then this number would be 30. 3 times 30 is what? 90. $70, 90 minus 70 is what? 20, right? Negative 20. You lost more than you earned. Okay? And in a moment, I'm going to show you guys how even having a 90, well, I'm not going to, I won't ruin it for you. There are certain risk to reward ratios with certain win percentages that work and others that don't. If you don't know what these are or how to figure them out, you're hopeless. You're not going to be a successful day trader. And you cannot take the aggregate of all your trades and all your trade setups and all your currency pairs and whatever win percentage that is and try to use these ratios. It doesn't work that way because each currency pair moves differently than every other currency pair, and they move differently at different times, right? Some currency pairs are active in the morning, some are active in the evening, right? Same thing with the futures market. Not all indexes are the same. Not all shares are the same. Not all gold and silver and other markets are the same. So whatever your approach is has to be specific to the market or the currency pair, has to be specific to the time that you trade, has to be specific to the setup that you trade at that time. And if there are multiple trade setups, then those have to be separated within that same time. There is a math and science to this. You cannot, if you're not willing to do the work, if you want to take the easy route, go right ahead and go broke. That's the choice. So if you thought this was going to be easier, this is like get rich quick, again, you're in the wrong class. It's not. So buckle up, suit up and boot up. But it's worth it. Because once you get the work done, once you've back tested, once you know the process of back testing, once you know how to figure these things out, it's rinse and repeat. And I can tell you, 2 or 3 setups is all you need. An hour a day, 2 or 3 setups. You need to be able to take 2 or 3 setups a day, anywhere from 70, 80% win, which, by the way, my students have, my expectation for them is that you are not going to be below 70% win rate. You are going to be above 70 or above. 70 or above. And by the way, it's too easy to be 70 or above with our indicators. And I'll show you guys those in a little bit, right? So there's no excuse for being below 70% win rate, but it has to be obviously within a risk to reward ratio that is profitable. Okay. All right. And we're going to talk more about that, Jason. So that's not the last time you'll hear about that stuff. That's actually the most important part of day trading. Okay. So let's move on. All right, so what did we hit? We hit support and resistance. We hit trend. We hit Fibonacci. We hit price action. So let's move on. All right, I'm going to show you guys a pattern. This is a hiccup pattern, okay? And I'll explain it as I go versus reading this stuff because I need to explain what each of these lines are. So let's go here, Euro USD. Let's get rid of some of these other charts. Okay, let's just go back all the way to the far end of the chart. All right, let me look for one here. Okay, so here's a hiccup pattern. Now, I'm not assuming that you guys know anything about what you're looking at here or anything, but I'm going to show you a pattern as if it were a square or a circle or a rectangle. And again, the idea here is to cut through all the jargon, right? Yes, Alan, these are our proprietary indicators. And these indicators may look similar to other things that are out there, but and then I'll show you here in just a moment how they are vastly different. And if you don't know what you're looking at, then you don't know the difference, right? So I'm going to break these down for you. All right. So these are the majors and minors: major impact, minor impact. We're going to use those. This is the pressure indicator. We're going to use those, and we're going to look at the candlestick. We're not going to use these oranges and blues for this setup. Okay. So these are patterns that we teach our brand new beginners, so that they can start using the indicators without having to feel like they have to know everything about the indicators. Okay, so it's just a square peg, square hole. Majors, the first thing we want to see is this red line represents the oversold portion of the market. Okay, like we were looking at with those scales, when that sell scale, when that sell pan is all the way down, it's oversold. When that buy pan was all the way down, then it's overbought. Okay, and what happens when they're overbought or oversold to a certain degree? They can't go any further unless the other pan gets heavier, right? Or there's weight released off of one of those pans. Okay, so oversold, we want to see what we call a hiccup. Now, this is a hiccup pattern, but the hiccup can happen on major or minor, but we want it to happen on the major for this hiccup pattern. And a hiccup just basically says the lines within the pair are pointed in opposite directions. So green is up, right? And red is down. It's a hiccup. They're not crossed or touching at the end, not crossed or touching at the end. So we call it just a hiccup. Okay. Now, while that is occurring, we want minors to cross and touch the threshold of the oversold, or beyond, be in the channel or further up. Majors, we want them to be down here in that hiccup position, oversold. Okay, so that's one. Minors crossed and pointed up in this example. Pressure, we just want that green line to be on bottom of red. So that green line to be below the red line. It doesn't matter if these are pointed up. It doesn't matter which direction they're pointed for this setup. So green could be like this even, and red could be like this, but green is on bottom of red. And here, green is on bottom of red as well, okay? So don't focus on which direction they're pointed for this, but just that green is on bottom of red, okay? That's the third thing. Fourth thing is just a contrary candle. That's a green candle. That's what color we want it to be, okay? We are going to sell in this particular scenario. Now, if you think about it, it seems counterintuitive. We're oversold. These are starting to bend up. We got a green candle, and we're saying we're going to sell, okay? But that's what we're going to do. This is a sell indication, and then I'll find a buy indication here in a moment. Okay. So right here, we'd want to sell. Let's just use the parameters. We're just going to make up some parameters, right? Because in order to determine what your stop loss and take profit should be, no one can just tell you what that should be, by the way. And people do this all the time, and it's so frustrating to watch and see, and people just eat it up. Oh, wow, that's amazing. No one can just tell you because they don't know when you're able to trade, what market you're trading on, what currency pair you're trading on, any of that. And all those variables go into what is going to be profitable. Okay, don't let anybody just tell you unless they know specifically how you trade, when you trade, or they're telling you to trade specifically when they trade, on the currency pair they trade, all those things, right? They can't just tell you, oh, this generally works this way. Forget generally. You want to make profit. And the only way you make profit is if you're precise, okay? So I'm giving you this just so we have something to kind of focus on, but this is probably not the way. I mean, statistically, it's probably not going to be the way you would actually trade it, right? We like to use these because when we train people and we get them to put in trades with these setups, it gives enough room so that they'll see both, some losers, some winners, but they'll also see the ebb and flow of the market with enough space, right? But they actually get to see it and then practice it. Go into a demo account with paper money, press the button, set the stop loss and take profit, and watch it happen in the live market with paper money. But then they have a goal, right? Because right now, none of you guys know how to backtest. I know you don't, because vast majority of people that are just learning or have been in the industry for decades even don't know how to backtest, right? And we're going to talk about that and why in a moment. So I'm just making these up, okay? Just so we can have a target. So our target will be 5 pip take profit, 10 pip stop loss. So we want this to go down, right? And then, so right there it goes down 16.5. So as long as our take profit was within, let's say 15 pips, because there's a thing called spread, and we'll talk about that later, then we would have taken profit because our drawdown was minimal, 1.5 pips. Okay, let's look at this setup. Overbought. Let's see if we can find one. Okay, right here. Same thing. We've got majors creating a hiccup. So green down, red up, not crossed or touching. Minors crossed and touching the threshold or beyond. Green pressure on top this time, right? So we're overbought. We want green pressure on top this time. And a red candle. So back here, we want a green pressure on bottom, green candle. Here we want green pressure on top and red candle, okay? Now let's try to look at the follow-up on because there's 2 follow-up trades that we can do with this as well. But first, let's look at some technicals. Now, the only reason I'm drawing these technicals is just to draw a correlation between what we see in technical analysis and what we see in indicators. So does this chart go back far enough? Let's see. Mark that. No, okay, hold on. Maybe this one does. Yeah, this one does, okay, good. All right. Where's that? There we go. Okay. So let's look at some technical analysis. Because we just learned that, right? So let's just tighten this up. And okay, good. What do we see here? Uptrend or downtrend? Somebody. That's the easy question. Come on. Uptrend or downtrend? Feel free to unmute, shout it out, chat it, something. You guys need some coffee? You guys still asleep? Down. Thank you, Peter. Appreciate that. All right. Hey, Cobes, we got any of those coins? We got these coins that we had stamped. They're Troy ounce coins. Let me see that bag right there. That gray one. Yep. Peter, I'm going to get Tim to get with you here in a moment because I'm going to send you this. This is a Troy ounce. If you guys are looking at the screens, 1 Troy ounce silver coin. They're stamped with some of our logo emblem, has a bear and a bull on one side or the other. Oh, Tim wants to give you the box. Okay. All right. Tim's going to give you the swag box. So you got a lanyard, you got a pen, Day Trade Smart letterhead. You got a pen right here, Day Trade Smart, USB drive, and one of these Troy ounce silver coins, and a lanyard. I'm going to send that to you, Peter. Thank you for your participation. All right. See, if I led by that, right, and I was like, all right, if you guys participate, I'm going to give you guys some stuff, then everybody would be sounding off. But I needed somebody to step up and then for everyone else to feel like, oh, I missed out. I'm not going to miss out again, right? It's just how our brains work. All right. So let's get to this. Okay. So let's draw in our current market price, and let's draw in, since we were talking about trend, let's just draw in some trend. I'm not going to use that because that bows it out too far. Let's go from here, and let's see what that gives us. Yeah, it's good. And right there, maybe even right there. Yeah, it's better. Okay, so a little outlier right there, but that's okay. And then we got resistance. We can see that, right? Boom, right there, and then where we currently are. So this line is our current market price. Got resistance right there. We got support right there and right there. And we've got, that's 34. Oops. That's 14, 15. That's 32. Good. All right. So we've got 2 lines above, 2 lines below. We've got our trend line. Okay. Now let's go back to this candle right here because that looks interesting. Okay. So those of you guys that have traded before, you guys probably recognize a lot of this, right? And for those of you guys that have just joined us today, in this chart that you're showing in money, is there a limit up or down? No, there's in money, like in how much you can make. Sorry, Sergio, I'm not. Yeah, no, there's not a limit to how much you can. No one's going to cap you. You just make whatever you know. Obviously, you want to abide by money management, so you don't want to just try to, break the bank and risk everything on one trade. But no, you're not going to be capped. You can make as much as you want all day, whatever. So there's not any kind of cap. Okay, so we're at the top of the trend, a downtrend, right? And we just hit a resistance level, right? And we bounced off of that resistance level. We're on the top of the trend. So those two things are telling us we should short. We have a candlestick pattern right here for those of you guys that are familiar with that garbage. And it's a hammer, right? Or, I don't know, some people might call it a shooting star or whatever. But that's also telling us that there's indication short, right? Now, what were we looking for before to tell us when to pull the trigger? Price action, right? We were looking for price action before. Okay, so next candle, what is that price action? Is that a buy price action or a sell price action? Well, the high is lower. Yeah, if somebody's going to let me know, go ahead, speak on it.
No.
Sell, thank you. It's a sell indication, right? The high is lower than the previous high, and the low is lower than the previous low. So we've got a sell price action. So that's telling you go, sell, right? Okay, so if we're going to sell from right there, and we have about 36 pips to our next level of support, then we're going to take at least 18 of that, right? So if that's our entry for a sell, let me erase that and use this black line instead because that was our entry. If that's our entry, 1.0628268, and we're going 18 pips, which is half of 36, so 626 minus 18, our take profit would be 608, 1.06088. 1.06088. And that will make blue. Okay. Now, what do we know? We know that these work about 50 to 55% of the time. So our stop loss would have to be half that, which would be what? 9, right? 626 plus 9 is going to be 635. 635.8. So 1.06 358. Excuse me, 358. What happened? Why didn't it type it? 8. There we go. And we'll make that line red. Okay, that would be your setup, right? Oh, okay, I get what you're asking, Sergio. Yes, and I'll answer that in a moment as well. $500, what is the outcome of your, okay. I know what you're asking, and I'll get to that in a moment. Thank you. Okay, so right here would be where we don't want, where you wouldn't want to go, and right here would be where you do want to go, right? This is your take profit, and that would be your stop loss, and this is your entry. Okay, now check this out. You guys, within 10 minutes, I showed you this pattern, not all that other stuff, just this pattern. And this says, nope, don't sell, buy, go long, right? Okay, so we'll go long. So we want to go up, right? Not down. And we want to go up by about the same ratio, just in reverse, right? Because we were saying, well, let's just use a 10 pip stop loss, 5 pip take profit, which, by the way, with that 2 to 1, we know that we'd have to win this trade at least 70% of the time or better in order to be profitable. And the better win percentage, then the more profitable it would be. Okay, so we want to go long, and the market moves long. Now, notice that it touched their stop loss, right? And that's just based on our, just looking at analysis. Maybe they had their lines drawn differently, but I'm going to show you how the indicators actually showed us that they did in fact hit their stop loss. And I'm going to break this whole thing down for you to show you exactly what the indicators are telling us step by step, okay? Now, right here, this is where we would see the opportunity to follow up. So right now we took that buy, right? And let me measure that just so we can appease the masses, right? So from there to there is about 11.7 pips. So that would have been fine for a take profit. Okay, now we have what's called a double confirmation up after a fake out. And the hiccup pattern is a fake out. So we faked out, or the majors faked out the minors, then they pushed up, then the minors are both of them are overbought, pointed up. Okay, so this tells us get ready to sell. And when it says, when we say get ready to sell, that means look for positioning, right? So if we're going to look for positioning, then we're going to use a smaller time frame chart. Okay, and looking at a smaller time frame chart, we're going to be looking for a couple things. So we'll use a 5-minute, and you can see that this is linked to this one. So this is showing the last 5 minutes of this 60-minute candle. So the next candle will be the first 5 minutes of the new candle. Okay, and what we want to see, the new 60-minute candle. So what we want to see is, and I'll give you guys the most common, and that is major minor on a 5-minute, either both pointed up after having resided overbought for at least 2 candles. So all 4 of these lines pointed up after being above this blue line for at least 2 candles, or after being above that blue line for at least 2 candles, minors begin to fatigue, maybe even create that hiccup or cross softly down, and majors persist. And either of those would be our entry for a sell. Okay, those are the most common. So those are the ones we'll talk about today. And I've got a video. It probably wouldn't do you guys very much good unless you're part of our, you have access to our indicators and things like that. But I actually have a video on aggressive positioning that goes over a number of 5-minute setups that you could use to position for a longer time frame, for a longer chart. Okay, so right here is our starting point. And so let's look for our entry. So majors are sideways, minors are down, still overbought. So we're good, but that's not our entry. Both major and minor are kind of sideways, so nothing there. Majors are now pointed down, minors are pointed up, nothing there. Major and minor in the channel now, so they left the overbought. It looks like we moved down a little bit. Let's see what that equates to. About 3.3 pips, so not much. Okay, so let's wait for a better entry. Now they're both pointed up, but they weren't previously overbought. So if they had been overbought and then pointed up like that, that would be where we would enter our sell. Okay. So these indicators work three different ways: logically, illogically, and pattern based. Logical is how it sounds. They point in a certain direction. That's the direction you trade. Illogical, sometimes they point up and we say it's time to sell. Sometimes they point down and we say it's time to buy, right? And pattern based is what I'm showing you right now, which can have logical and illogical facets to it, but we're just focusing on just the pattern, right? Okay, so nothing there. Okay, here we go. So minors are fatigued, majors are persisting. So right there would be our entry to sell, okay? So right there, and let's just say we're going for the same thing: 5 pip take profit, 10 pip stop loss, 106.479, so 106.429, 106.429 would be our take profit, and this would be our entry. Stop loss would be 106.579. Ooh, almost right on it. Okay, so obviously here we just want to get to that blue line before we get to that red line. Ooh, close. There we go. Okay, so let's look at what that looked like on a 60-minute. Well, all we had was a wick, right? This wick right here. 106.479 would have been our entry. So as this wick moved up, 106.479, we would have gotten in right there, which is almost at the very top. It looks like it might be the very top. Almost, just a little bit from the top, about 1.7 pips from the top. And then as it came back down, right, we took profit, okay? Now that's the first follow-up trade. So to this point, we would have taken a buy, and then because these are both pointed up after the after a fake out, then we would position for a sell or just take the sell. And then after that, usually these lines are both pointed down. Major and minor are both pointed down usually, but they're not yet. So let's wait for them to point down. Okay, now they're both pointed down right there. Then we would sell again. Good. So that one moved 7.4 and only moved up about 4.6. Okay, so what did we see? Let's go back. Okay, and I'll show you guys more examples of that. Oh, where are we? There we go. Okay, so let's break this down. So what did we see? Well, the market, like we were looking at with that scale, the market is overbought, right? It's overbought, which means that buy pan is on the ground. So you can't go any further, right? Not much, if any. It's overbought. Okay, so the majors, the big players, all they've got to do is take money off of this, out of the market, take lots, take trades out of the market, cash them out, right? Take profit. Okay, when they do that, what happens? This pan gets lighter, and we saw that they did that. They are neither buying nor selling. Red is up, green is down. That's that hiccup we were talking about, right? Okay, so then it goes to the sell side, right? It strengthens to the sell side. So miners say, okay, what do we have? We have our price action. We're on the top of the trend. We just hit resistance. We have our candlestick pattern. Let's sell. Now that we got our price action saying sell, right? So what do? They start to sell, right? Okay. And we can see that they started to do that because that's the indication they were giving us. They were crossed and pointed down, okay? So let's go back to the charts real quick. What were they doing? They were selling. Majors were neither buying nor selling. They were just releasing trades. Okay? How do the majors know when to release trades to get the miners to sell? This is intentional, guys. This happens. This stuff happens by intention. Okay. But how do they know? Because there's no way possible for anyone to know how many lots are being bought or sold. Not even banks, not hedge funds, none of that. There's no, you can't tell that information. And even if you could, it'd be illegal for anybody, including banks. So how do they know that it's time to release trades so they can get the miners to sell? Because if the miners sell, then that releases the buy from being overbought, and now you can buy again. How do they know? Well, who do you think invented support and resistance and trends and channeling and introduced Fibonacci into the markets? Do you think it was a day trader, or do you think it was an institution? It is control. It's the institutions that invented that stuff, and they teach you that stuff because if they teach you that stuff and everybody does it, then they know exactly when to take advantage of you. Are you getting wise to how this game works? This is not hyperbole. I'm not just making this stuff up. This is how it works. Okay? So what edge do you have then? I'm showing you the edge that you can have right here. Miners are selling because they took the bait. Top of the trend. Trend is your friend. Resistance, candlestick pattern, price action. It's time to sell. Okay? So then they put money on that. They put lots into that sell pan, right? And what do majors do? They take the money that they took out of the market and put it back into the market, put lots back onto the buy pan. And we can see that they did that because it made that look right there. Boom, right? That's what they did. Okay. So what happens to that pan then? It goes back to the buy side. And as it starts going back to the buy side, the miners hit their stop loss. How do we know that? Because after that firm cross down, they soft cross back up. It's not because the miners said, whoops, we made a mistake, we should buy. Nope, it's because they hit their stop loss. And we know they hit their stop loss because of this pattern right here. We know that they got stopped out. So right here, they got stopped out. They crossed with intention to sell, didn't get their opportunity to sell. As the market went up, it hit their stop loss and it caused those lines to cross and point up. When the majors do that, it's intentional. When the miners do that, it's because they didn't have a choice. Okay, so what happened to all of those dollars that were on that sell pan then? Not all of them, but a lot of those dollars that were on that sell pan, what happened to them? Well, they got taken out of the market and given to the winners. That's how it works. It's a zero-sum market, right? Okay, but now there's less weight there, and there was weight added here. So now this is what? Overbought again, right? How do we know that? Majors are up, minors are up, and they're above the overbought with double confirmation overbought. We know that 60 to 65% of the time when that happens, there's still some buy left. It'll still move long a little bit. So we can position, which is what we did with our 5-minute. We positioned, and sometimes there is no positioning, right? So what do? We waited for our entry, right? Right there, and then we sold, right? Because these lines were pointed up after the fake out, we knew that we were going to get ready to sell because there's nowhere else to go, right? Okay, so first trade was up and we saw why and what the indicators were telling us, because although you might not be able to speak the language right now, I let you into some of that language, right? Okay, so after that fake out, we had double confirmation up, which means we're vastly overbought, so now we need to get ready to sell, right? So after we get that sell, which we got up there as it came back down, then usually these lines are both pointed down and then we'd sell again, but that didn't happen until there. So then we sold again. Okay, now in reverse, it would be, so here was buy, sell, sell. Down here would be sell, buy, buy. Okay, so let's look for one in reverse. No, Sergio, it's the same. It's going to work the same day or night. but how many pips you take, what your win percentage is going to depend on the time you trade, the currency pair you trade, all those things. But you're by back testing, you'll find something that is going to be profitable. That's what matters, right? It's not like it doesn't work or doesn't work. That's not a thing, by the way, guys. Everything can work. Everything. Just you can flip a coin and figure out how that works. I'm not kidding, right? But so we're going a little too far into this, and it takes a lot of time to explain these kinds of things. But day trading is back testing and money management. Okay, so you back test, and we'll get to some of these things here in a moment, some of them, because there's a lot of information there. But I understand what you guys want or think you need, but it's not what you think. It's what you think you need is not, right? And what did I tell you? What was I telling the gentleman that asked earlier on in the session? I made a commitment. I'm going to show you guys not only how to vet anyone, but how to vet us as well. And I'm going to get to that, right? So I don't like leading with this kind of stuff, but I realize that the only way I can captivate and keep your guys' attention is to show you something that works. I need to wow you guys right up front so that I can show you the things that you need to know. This is just how it is. We're entertainment driven. So I want to entertain you. I really do, because then that gives me the ability to teach you. And that's what I really want to do. That's my heart. That's why I do what I do. That's why you're seeing me here and not one of my other people that I can just hire to do this for me. And that's why Tim's here, because we love this. This is our baby. And we've been nurturing this baby for over a decade now. We love this. We've got thousands of traders, and we make it a point to do our best to try to talk to as many of them as possible whenever we possibly can, which is impossible, obviously, right? It's too many of them. But whenever we can, we try to make ourselves available whenever we can. All right. So I'm telling you that because I want you guys to know that what I'm going to show you next is going to blow your mind. Okay. I'm showing you setups right now. I'm showing you that these things work. I need to give you some proof, and that's what I'm going to give you, right? I'm going to give you that, but I need to show you what day trading really is and what nobody else is telling you, why people fail at day trading. That's what you need to know, and you need to know the hard facts, the hard truth, and we're going to get to that. All right, let's look for another setup here. Let me erase these lines. This is actually a head fake, okay? So head fake, and I've got flashcards on all this stuff. I got videos for days on all this stuff, going back 5, 6 years on some of these when we first started introducing these patterns. You can look. Anyway, let's get to this. Now, this is another fake out setup. But it's very similar to the hiccup pattern. So I'm going to show it to you guys. Now we want this cross to happen, but we want the majors to be hung back below the oversold. And we want minors to actually be in the channel, having taken the bait and crossed and pointed up in this scenario. We want green to be on bottom, just like in the hiccup pattern. And we want there to be a green candle, just like in the hiccup pattern. And just like in the hiccup pattern, we are going to short or sell here. This is illogical. This looks like one of those illogical setups, right? Because these are pointed up. Why are we saying sell? Well, because the indicators are telling us that. These small nuances, this minutia is telling us you need to sell here, right? Majors are taking advantage of the minors. They're faking them out. Minors have taken the bait. There's just so much here. I'm not going to cover all of it, but there's sideways there. We see sideways there. There's some TNT stuff. Okay, we're not going to talk about it. Let's focus on just the pattern here. Okay, so the only difference between what we see in this pattern and the other pattern is just how the majors look, which is crossed and pointed up, but hung back, oversold. And the minors are crossed, not just touching the threshold, but actually in the channel or beyond. And then overbought would just be the same thing, just in reverse, right? So here we are looking to sell, right? We would be looking to sell. So I just got to point out the obvious here. This is just too obvious. Okay. No, it's not the traders don't have the experience that I have. It's just they're using. It's not necessarily about experience. It's just about the tools that you're using, right? These indicators, we only have them. We're the only ones that have them. So miners can't see these indicators. They see what I'm about to show you, which is just blatant. So I'm going to take a moment to show you. For those of you guys that were paying attention, there's a higher high and a lower low, and it's a green candle. What is that? What is that telling? What is that telling them? What direction is that going to move? That's price action. What direction? Price action. Anybody? Or somebody?
Buy.
Buy. That's price action buy, right?
Yep.
That's a reversal. That's, I mean, and for those of you guys that know price action, that's what that says. Look, I'm not making up what the chart is showing. You can go to this date, you can go to this time, and you can look at that, those candles. That's what the price was. I'm not, it's not like I'm making this up for your sake. This is just what it is, right? And at that moment, they were saying buy. So is it because of their lack of experience? No, it's because of their experience with the wrong indications. Plain and simple. Can they make money on those wrong indications? Yes. If you use money management, you can. And we're going to get to that. We're going to get to that. All right. So right here, we're saying sell. We're saying short. Okay, good. So it shorted. That moved up about 2.4 pips and went down about 16.7. Now here again, remember before when we went long and then we waited for all those lines to point up? Well, here we went short and now we have all those lines point down. Not merely because they're pointed down, but because they're pointed down after a fake out. So illogically, here again, it doesn't make sense, but this is telling us, look, if the buy pan or if the sell pan is all the way maxed out, we're double confirmation oversold, what's the only direction we can go? Up, right? Buy, we got to go the other direction. It's a zero-sum market. So right here, indicators are telling us get ready to buy. If there's no positioning, then go ahead and buy, right? Well, we can see, what do we say? Oversold, if we're looking at 5-minute, oversold for more than 2 candles and both pointed down. So where would we buy? Right now, as soon as that new candle comes out, right? Okay. So right here, it still went short a little bit. 9.4 went up, 7.6, so not much, but it did go up, right? If we were going for that 10 and 5, we would have actually just missed our stop loss, just barely. I mean, it could have gone up first and then went down, but had it not, then we would have gotten really close to stop loss and then came up. Now, after that, what was the sequence before? Up, then down, right? And the up was the hiccup, in this case, the head fake. And so this one was down, then up because we had that double confirmation. Now, and then now we've got both of those crossed and pointed up. So we go up again, right? So this one was up, down, down, and this one was down, up, up, right? It's just in reverse. So then the next candle we expect to be long or buy. There we go. So that one moved up. It moved back 5.2 pips, and then it moved up 21.6. And then actually this is, oh, I haven't showed you guys. Well, we'll learn dirty pressure later. This is dirty pressure, so actually we could have actually, this is not part of the sequence. This is just a different pattern, but that would have given us another opportunity to take another buy right there. Let's see what would have happened. Yeah, that's fine. That would have worked out too. 3.3 pips down and then 18.8 up. All right, good. Okay, so let's see if we can find a couple more here, and then we'll take a quick break. I want to find another hiccup. Okay, here's another head fake. So majors crossed, hanging back, minors crossed in the channel, right above the oversold. Green candle, green on bottom. So we're going to sell. Then if both of these lines point down, then we'll take a buy. And then if they point up after that, then we'll take another buy. All right. So first one is sell. That moved, yeah, 36.1. That was good. It moved 3.4 up against us and then 36.1 in our favor. So that's fine. It's just really consistent when we get that double confirmation after the fake out. So now those are both pointed down. We know 60 to 65% of the time it can still go down a little bit, but we're looking for a long trade or buy trade. And yep, that one moved about 1.7 pips against and then 39 pips up. And then here again, major minor pointed up. So we take another buy. Actually, this is the setup that, again, the setup that we're going to learn later. It came early. Dirty pressure. I'll explain that one to you guys later. But anyway, all we're really looking for in this sequence is for these to point up after we take that sell, and then the buy, and then the third trade would be this next buy. So then we would buy again, and that one moved up 20.7, no drawdown. Good. All right. Those were head fakes. I want to find a. Okay, so here's another hiccup. Again, green down, red up, overbought. Miners crossed and into the channel this time. Green on top for pressure, right? And red candle. So we've got everything that we need right here. We would take a buy or a long trade, right? Okay, good. That moved up 8.5. It did move down about 3.9, not much in either direction. Both of these lines are not overbought or pointed up yet, so we're not going to take the sell yet. Majors are up, minors are not overbought yet. Majors down, minors up, but still overbought, but they're not pointed up yet, so nothing there. Majors pointed up, minors still pointed down, nothing there. Majors and minors up, overbought, right there. That's our indication to now sell. Okay. So right here we went 1, 2, 3, 4, 5 candles of green up, and now our indication is telling us, okay, good, now it's time to sell, right? We don't need an indicator to tell us that the market is moving or trending up. We can see that with our own eyes. We don't need an indicator to tell us that we've got price action right now, that the price action is buy, right? And especially if it doesn't work very consistently all the time, right? We don't need an indicator to tell us what's already happening. Okay, it's like a weatherman telling you that it's raining outside. Well, great. I don't need for somebody to tell me it's raining outside. I can see that. Tell me if it's going to rain outside, but not just tell me if it's going to rain outside. Tell me and be accurate if you're going to tell me it's going to rain outside, right? Be accurate vast majority of the time. No one's going to be right 100% of the time. No indicator, nothing is ever going to be right 100% of the time, but be accurate most of the time. If you tell me it's going to rain outside, I want to know vast majority of the time, 70, 80, 90% of the time that it's going to rain outside. Okay. And even more, tell me how long it's going to rain for. It's going to rain outside for this long, right? So if we look at indicators, and we always use this as an example, a good indicator by industry standards is one that tells you it's raining outside, right? A good indicator is a trend. That's a good indicator. That's in the industry, that's the standard, because it tells you the market is moving up. Well, no kidding, right? Okay. So a better indicator tells you, well, the market is moving up, and it's likely to only move up for this amount of time and then bend, right? Okay, that's better, yes, right? But you're still telling me what's already happening, maybe a little bit about how long it's going to continue to happen. The best indicator tells you it's going to rain outside, right? It's going to go up, and this is how long it should go up for. It's going to go down, this is how long it should go down for. But again, it's got to be accurate. It's got to be accurate. Otherwise, just guessing doesn't do you any good, right? Or 50, 55% accurate is not good enough. It's not. You can't really, it's difficult to work under those parameters. You can, but it's difficult. Okay? So right here, we know now that our indicators are telling us now is the time to sell or short, right? There you go. So 1.7 draw and then 9.4 down. 1, 2, 3, 4, 5 hours of up movement, and we knew when to sell. Okay, so let's go ahead and take, let's see, what time is it? Okay, we're going to go ahead and take a, what do you say, Cobes, 15-minute break? Let's take a 15-minute break. Let's just say right now, let's come back at the 45. So right now it's, on my time is 11:27, so let's just call it 11:30. So depending on where you are, but just come back on the 45, use the restroom, get a drink. Let's come back because I've got some solid, heavy hitting stuff to hit you guys with to prepare you not only to find and seek out the correct information that you need in order to be a successful day trader, but also provide some of that information for you today as well. So definitely come back for that, and we'll see you guys in about 15 minutes on the 45. All right, see you guys in a sec. Just looking at some of these questions for those of you guys that are hanging out here, waiting for the session restart. Feel free to ask questions, and we'll just go ahead and have some Q&A while we wait for another 10 minutes to get going again. And I'll readdress these questions at that time as well. But if Sergio and Peter are still listening, I'm going to try to get to some of your questions here. There are differences in the day or night because of different times in the world. Yeah, so Sergio's just asking, is there a difference to do this day or night because different times? And there's always going to be a difference regardless of whether it's day or night. There's going to be a difference in day versus different currency pairs, different markets, you know, S&P or the SPY or the Russell, right? There's going to be a difference in all of those. And then within Forex, it's going to be a difference in currency pairs. Gold is going to be different than silver. So they all work, right? They're all going to work, but it's just a matter of how they work. And the way you figure that out is by back testing. When you say miners, are you taking the bait? Are traders experience? Oh, right. I already addressed that one. Let's say I buy, my system goes down. By the time it restarts, I had to sell, but I didn't. Oh, okay. So you buy, your system goes down, but the time it takes to restart, you had to sell, but you didn't. So when you buy, you set your parameters up front. You set a stop loss and a take profit. Some people say, oh, trail it and use all this. Look, that stuff just doesn't work effectively. It really doesn't. I mean, you can figure out how to do it that way and leave your trades open. But it only takes one time for the market to just haul off in the opposite direction for you to never do that again. I definitely do not recommend that. If you look at professional day traders, people that are actually professionals and doing well at day trading, they don't try any of that kind of stuff. You don't get down like that. So once you enter a trade, you'll notice that when we were drawing our lines, obviously you wouldn't be drawing lines, you would actually be pressing a buy or a sell button on whatever broker that you're using, and then setting a stop loss and take profit, which essentially tells that ECN, that electronic communication network, when you reach this level, remove me from that trade and award me my profit. Or when you reach this level, remove me from the trade and I'll take the loss, right? And if you've back tested, then you know where those parameters should be and how much to risk on that trade, right? And we'll kind of go over a little bit of that later on. What does this work best with, Forex stock or other vehicles? You name it, Peter. It works great with, I mean, I haven't seen it not work better than anything else with any other market. And I realize that the focus sometimes becomes on the tools, right? So I'm going to hit you guys with a quick analogy because that's just how I see things and how I feel like most people can relate to understanding. And I'll reiterate this later as well. Matter of fact, I'm going to pull something up for later. Okay. Yeah, I'm going to go through those real quick here in a moment. Yeah, so just, you know, any market you're able to use it with. Matter of fact, if you go to daytradesmart.com, the videos that we have on there, I think, are on the futures market, like the S&P minis. We're just knocking down quick scalps, like half, quarter pip, you know, type trades, and that's on the futures market. So, you know, you can take a look at some of those demos as well.
Question when you get back. My question is, does it work on the native Mac OS or is it Windows only?
That's a really good question. So for whatever reason, and I know why you're asking this, because a lot of programs only work on for day trading, and it's funny because, you know, ECNs have been around since the early 90s. Most of them are going to work on Windows OS, but what we do for individuals that have Mac is have you install like Parallels or VirtualBox, which gives you a Windows OS on a Mac. So you just have like a separate operating system running on your Mac. But you know, the best bet is, I mean, when I first started trading, I was strictly Mac based. I had, MacBooks, iPads, iPhones, which I still have most of that stuff, but didn't have Windows based computers. And after started trading, I invested in some Windows based machines, but even a simple laptop would do. You don't need anything that's super fast. You don't need this jacked up, computer. You don't have to go spend thousands of dollars on a machine to day trade. That's a myth. If you find that you are feeling like you have to be quick on the trigger and always anxious and eager, or rather anxious to get into a trade, because you've got to be, knee-jerk reaction, right? And no real notice as to when you should get in, it's probably not a good approach, right? It needs to be, there's a whole psychology in day trading, and the psychological facets are something that even if you've got everything mastered, that can really destroy your trading career, because you start making emotional decisions as opposed to logical decisions based on your trade plan, right? Because maybe you've taken a few losers in a row or something, and I don't know if any of you guys are familiar with playing cards, but when you play cards like Texas Hold'em, there's a saying, it's called being on tilt. It's when you took a bad loser and now you're just emotional, and the things that would otherwise help you to win are now betraying you and causing for you to lose. And so it's kind of the same thing with day trading. Is when you take some of those losers, sometimes you want to, it's almost like you create this plan to revenge trade or try to win your money back and get back at the market somehow. And it's just it cascades into just chaos. So one thing that we focus on within our formal education through day trading is psychology of trading, right? So we teach our students everything you need to know about leverage, about free margin, balance and equity, about pips, some of the stuff that we're teaching today. Obviously, money management, back testing, how to back test, what to back test for, what information to collect, how far to go back when you back test, so on and so forth. But one of those big things that we teach about is psychology, and because we want you to be aware that it's there. But the best way to circumvent a lot of those psychological facets that would otherwise cripple a professional day trader is to not only be aware of them, but have a solid plan from which to trade, right? And so that's why it becomes one of our focuses. But I realize that wasn't part of your question, but it kind of led into that. So, but to go back to your question, yes, we can make it work on a Mac, and just about any program with any broker. There's ways to figure out how to make it work on a Mac or any operating system for that matter. Good question. Thank you for asking. Okay, so let's go ahead and get back to this, guys. I wanted to kind of change gears here really quickly. There was another question that was asked just about the different markets and things like that, but it brings about another question, and maybe you haven't thought to ask that question, but what I'm going to do is kind of explain to you the breakdown of what you should be looking for when you're looking for a program from which to grow as a professional day trader. Okay, and in a little bit, we're also going to talk about some of the myths and facts around day trading. But right now, I want to really quickly cover this topic, which is vetting education. So you want to ask the following: what is the focus of your education? Right now, I don't want. Let me rephrase that. I do want for you to look at this in a couple ways. I want you to look at this with speculation, right? And consider that I'm the one that's giving you this information. So I want you to question that, okay? Why would I say I want you to question that? Because all it's going to do is lead for you to find those answers, right? I'm gonna provide these answers for you, and what you're gonna do is you're gonna go out and you're gonna try to vet and figure out if the answers that I provided for you are legitimate, right? And you're gonna find that they are. And I want you to do that. So I want you to be skeptical. I want you to be skeptical. I would be if someone else started a conversation with me saying, well, I'm going to show you what to look for when looking for a trading education company, and it was somebody that offered trading education, believe me, I'd be like, why should I listen to you? Because all you're going to tell me are the things that lead me to you, right? And yes, that is true. All the things that I'm telling you are things that are going to lead you to me because I have the right answers, right? But is it because I'm trying to lead you to me, or is it because I am giving you the answers that are true? You've got to figure that out for yourself. I don't want you to take my word for it. I really don't. You looking into these things is going to, your word is doctrine, not mine, right? The voice in your head that says, yes, I can see that this is true. That's doctrine. Even if your mouth speaks out differently, right? The thoughts in your brain are saying, yes, that's valid. I can see that now. But that takes you finding that, you seeing and finding that information, not somebody just telling you. Otherwise, it's kind of half-hearted truth in your mind, right? There's, if you guys have ever watched like Tony Robbins or a lot of these other people, that do these inspirational type speaking, they talk about a lot of them talk about these 3 circles, right? One of them is, you know what you know. Obviously, you know the things you know, and you know the things that you don't know, right? Let's say you don't know anything about vehicles, so when you go to a mechanic, you're always wondering, are they going to charge me for some blinker fluid because I don't know that there's no such thing? Are they going to say that there's something wrong? Then I wouldn't know how to verify whether they're telling the truth or not, right? So you know what you know, and you know what you don't know. I don't know anything about that, right? There's a sport called cricket. It looks interesting. I don't know anything about it. I know I don't know anything about it. And then there's this whole other circle that's much larger than those 2 circles. And those are the things that you don't know what you don't know, right? You don't even know that you don't know those things because you don't know anything about them, right? And for some traders, it's something as simple as ratios, risk to reward ratios. I didn't know that I couldn't just use whatever stop loss I wanted to. I didn't know that I couldn't just put in whatever lot size I wanted to, right? Another question that was asked earlier was about how much would each of these trades be worth, right? And there's no clear-cut answer for that. And if somebody tries to give you one, they're lying to you because it's based on risk percentage, and risk percentage is based on win percentage and risk to reward. So the only way you get those is by back testing or somebody knowing exactly when you're going to trade. If somebody tells you this is what I risk, that's because that's what they risk based on, and they're successful. That's because they know what their win percentage is for that setup on that market at the time that they specifically trade. And based on those numbers, this is how much they risk. So they can tell you that, but what they can't tell you is what it would be for you unless they know the specifics of how you're trading, right? And when you're trading. And beyond that, there's a number of questions you need to ask yourself when determining what is best for you, right? Because we all want certain things, but what do we need? What's best for us, right? When we're children, we all want candy and sweets, but it's not what's best for us, right? We need some vegetables. We need some iron and protein. We need all these other things, right? Not just candy and sweets. So it's considering those things. What is my risk appetite? What is my personality like? What are my experiences in life that are going to lend to my 10 years as a professional day trader? And when you try to circumvent that nature within you, then you are trying to take yourself out of who you are, out of your own nature, and try to put yourself in something that is unnatural, and you always feel like this fish out of water. We find the most success by taking day trading and form fitting it to the individual versus the other way around, the individual trying to form fit to day trading. There's no cookie cutter approach. There are, but it's cookie cutter, and you just got to hope that you fit into that. And if you do, great, then it works for you. Awesome. Then it works for you, right? But it's better that you have something that is form fitted to you, unique to your situation, right? People work different hours. There's different times of the day that they're available. Their risk appetite's different, so on and so forth. So what is the focus of your education? This is what you ask people if if you want to learn from them, especially if it's free, guys, you get what you pay for. So believe me, my program is not free, and we'll get to that. I'm gonna show you, and nor do we don't accept everyone. And I'm not just saying that. We reject people on a regular basis, not because we don't like them, but because it's not a good fit. We vet people first, just like you would vet us. We vet you through a trial program, and all we look for is good students, people that show up to appointments or communicate otherwise and are teachable and attempt to do the homework. We don't expect for you to get anything right. We don't expect for you to make profit. We just want a good student. If you go to school and you're not teachable, you don't learn. If you don't go to school and you're the most teachable person in the world, you don't learn. You have to have both. If you have both of those things, we know we can teach you and trust you with trading our corporate funds, right? So we don't just go out and give out money everywhere. That's ridiculous. We are a legitimate company, and as being legitimate, we are wise with our money, and we expect that the people that we bring into our organization will also be wise. So although you guys are asking questions, and I see them, and those of you guys, they're great questions about, what does it cost? And I'm going to get to that. How do I trade with your indicators, right? First of all, that right there is why I'm going to show you this first, because that's not necessarily the right question. Okay, but let's talk about this real quick. So you want to learn the following: proper back testing. There is improper, just like there is proper. It just is, right? There are scientific models that already exist, right? How do they tell the weather? How do they predict the weather? How do they predict traffic patterns, right? How do they predict anything that takes prediction? There's autoregressive models. They're predictive models, right? If somebody doesn't even know, they don't know that they don't know, then it doesn't even occur to them, right? If there's an organization that doesn't know, then it doesn't occur to them. So they don't offer it. It's not because they're trying to pull one over on you. They just don't know any better, right? Okay. Proper money management and protection. Proper. There is improper as well, right? Proper money management and protection. Psychology of day trading. And then everything else. Did I talk about trade setups? Did I talk about patterns? Did I talk about alerts? We will talk about those things, but that's not what you want to learn to day trade. What you want to learn when learning how to day trade are these things first, and then everything else. Everything else, right? Okay, so let's use an example, right? Imagine you're building a house. What's the first step when you build a house, right? Some people might say, well, it's obvious, the foundation, right? Nope, the foundation is not the first thing. Well, no, of course, you got to put in, the plumbing first and then put the foundation, right? Nope, not the plumbing either, right? Well, what about the electrical? No, not the electrical either, right? So none of the above. So how do you start when you're building a house? Well, any contractor, any home builder that's worth their salt is going to tell you, you start with a blueprint. You start with a blueprint. If you didn't know that, now you know. Even if you've built the same house 10,000 times, when you're going to build it the 10,001 time, you're going to take out the blueprint for that house and you're going to build it based on the blueprint specs. So what are we saying? You need a plan. You need a plan. So here are the steps. Learn a setup and back test it. That's the only time a setup is relevant at this level is just so that you have something to back test. So learn, if you're going to use support, resistance, trend, Fibonacci, price action, EMAs, all those other things, right? Think about those things, by the way. EMA, exponential moving average, right? That's what it stands for. MAs, moving averages, MACDs, all these things are average. So what do you get? A 50 to 55% win rate, right? And we'll talk about that in just a little bit as well. So learn a setup. The only reason you're learning the setup is to back test it. So I showed you the hiccup pattern. Now you can back test that, right? If you had access to it. I showed you price action. Now you can back test that. Showed you support, resistance, and trend. You can learn more about those things and back test them. You only learn them at that point, not to trade them, but to back test them. You don't have a trade plan yet. You don't have the most important elements of day trading. Okay. Money management. After you've back tested, you know what your win percentage is, what your risk to reward should be, and hence what your risk percentage should be, what lot size you should use, basically, right? Know thyself. We talked about that. Does this fit? Does this trade setup fit my risk appetite, my personality, right? Is it going to be something that I'm going to be able to do or not? So you need to know these things. You need to ask these questions of yourself, right? Some people like when the market moves fast because they like to get in and out of trades really quickly. And when the market moves slow, it makes them anxious because they have to wait around. Other people like the market to move slow. They like to trade when the market is moving slower because when it moves fast, it makes them anxious, right? And they like to be able to just, take their time and execute, right? But if you go on to any of these other, go to YouTube, whatever, what are they going to tell you? You need to find the volume, you need to find the liquidity, you need to find when the market's moving fast. Again, it's cookie cutter. They want you to fit into that box. And if you do and it works for you, great. I'm not knocking it. I'm telling you, I know people, these are friends of mine that I met at International Traders Expos, money shows, right? I've met these people and I know them now, and we run around in the same circles. And they've been trading a lot longer than I have, and they're winning at day trading. They've made millions of dollars, right? And of course, I always ask them, would you be interested in my program? No, they wouldn't, right? Because they've already got it figured out. So I asked them, what if you could go back to the beginning? Would you have been interested in my program versus what you had to go through to get to where you are now? 100% of the time, they always say, absolutely, yes. I don't know one that wouldn't. And believe me, these are people that don't mince words, right? So now, am I the only show in town that has something that works? Of course not. No, but we'll get to some of that here in a moment as well, right? And then execute. Most important part. Once you're done, you got your plan. Now it's time to push the button. Religiously, you push the button. So if you have made a commitment to trading from 7 p.m. to 9 p.m. because you can't trade in the mornings, you go to work, or you're getting ready for work. You can't trade in the afternoons because you're at work. You can't trade early evenings because you get home, you want to spend time with the family, you want to have dinner, you want to maybe watch some television, whatever. But at 7 p.m., 8 p.m., whatever, 7 p.m. is the time that I'm able to sit down at my computer and look for my setups. All right, 7 to 9, that's when I'm trading. That means that if my setup happens between 7 and 9 for the setup and the currency pair that I'm trading that I've back tested for, I am going to execute. I'm going to push that button every single time it happens at that time to the best of my ability, like showing up to a job that I want to keep, right? You don't want to not show up or call in very often. You'll lose that job, right? It's the same way. 90+% of the time, I'm going to be there and get ready to press that button to trade. That's how you have to approach it. If you take it nonchalantly, well, it's going to treat you nonchalantly too, and you'll make a lot nonchalant kind of money. If you want to make real money, you want to be a professional. There's no such thing as a professional that just kind of, takes things lazily. You got to be serious about this, right? You want to make some real money, you want to change your lifestyle, you can do it. It's not going to be overnight. I would say for students that come on, I say give it 2 years. 2 years. Within that process, you're making money. Within the first year, what I want to see is ROI. I want to see supplement income. I want to see replace income, at least a supplement, at least to the supplement of income, right? 30-40% of your income you're making day trading now. And then soon after that, a replacement income. 100% or more of your income you're making now by day trading. And then after that, build wealth. Then you don't stop at just replacing your income. You build wealth. Right? You go beyond what your income was and you start building wealth. Those are the 4 steps you need to take. Okay. So once you've executed, right, you've learned your setup, you back tested it, you've applied money management, it fits your risk appetite, your personality, then you push the button religiously. And then rinse and repeat. Do it all over again. Learn another setup, back test it, money management, make sure it fits with you, execute until you have enough to meet your goals. Sometimes that's 1-2 setups on a handful of currency pairs. Sometimes that's 3-5 setups on a handful of currency pairs, whatever it might be. But you do that, and then when you've got what you need, then you can project where you'll be in a month and in a year and in 5 years and so on and so forth. This is how you do it. Okay. Let's see. Oh, we're not on that one yet. Okay, let's go back to our other slideshow. Okay. So we are going to talk about myths and facts of day trading. All right, so buckle up, because this is where we get real. I have to be quick on the trigger. No, you don't. You don't have to be quick on the trigger. You need to be good at math? Nope. You need to be good at charting? You need to be, no, you don't need any of that. Those are myths. I need to know how to do technical analysis. Nope, you guys saw that. I showed you patterns that you can do that you don't have to know how to do. You don't have to know how to do technical analysis or even know what technical analysis is. More movement equals more profit. So moving up, you know, trying to find a trade plan that you get a lot of movement in, that's going to make you more profitable. Higher win rate equals more profit. So if I have a 90% versus a 70%, I'm going to be more profitable with a 90%. That's also a myth. You guys are asking, how is that possible? We'll talk about that in a moment. Here's a fact. Did you know that over 95% of individuals who try to day trade fail? Over 95%, people just like you. Statistically, none of you guys in this room are going to be successful at day trading. There's only 10 of you guys in here. Statistically, none of you are, right? Are going to be successful at day trading by the industry standard. There's light at the end of the tunnel. Hang with me, guys. That is just the way it is, right? Okay. The average win percentage, okay, of day traders in the world is 50% to 55%. You guys can look this stuff up. Don't take my word for it. You can look this stuff up. 95% of over 95% of traders fail. The people that attempt to day trade fail. Yes, look it up. Their average win percentages are 50 and 55%. Yes, look it up. Okay, why? Because the stuff that they're using is average, right? Exponential moving average, price action, support and resistance, trend, Fibonacci. All those things are average. They're delayed indications. They're average, okay? It takes an average of 5 to 7 years for most day traders to become profitable. Profitable, okay? Not rich, not, you know, supplement your income, not replace your income, not ROI, just profitable. Now you're starting to make some profit. 5 to 7 years, okay? So let me tell you something really quickly. When my students backtest, they backtest 5 years. 5 years. So if you're trading from 7 p.m. to 9 p.m., those are your trade times, right? On the euro versus US dollar with the hiccup pattern, you're going to go back to January 2016 and you're going to test January 2016 to December 2020. 7 p.m. to 9 p.m. every single day from January 2016 to December 2020. You'll end up with, on the hiccup pattern, you probably end up with 400 or 500 examples. And you're going to collect specific information. It's going to take you about 1.5 minutes per line. After a while, you get faster, probably get down to maybe 30, 45 seconds per trade to collect the information and move on to the next. Okay? So you're talking about 5 to 7, maybe 10 hours on a 60-minute setup. On a 5-minute setup, you're talking about probably 10 times that length of time because they just happen more often. So there's more data to collect. Okay? Why? Because if we look at 5-year blocks of the market, we can find just about any overall condition that the market has existed, that exists in the market. Uptrend, downtrend, short-term uptrend, short-term downtrend, long-term uptrend, long-term downtrend, long-term consolidation, short-term consolidation, bias in one direction or the other. All of those overall conditions exist within those just about any, pretty consistently, just about within any 5-year block, right? Okay, so that accounts for the overall condition. The times that you trade accounts for that specific time in the market. The currency pair that you trade, because you're going to test one at a time, accounts for the specific currency pair at that specific time in the overall conditions, right? And the setup that you trade is that market condition when that setup occurs in that specific currency pair at that specific time of day when that market is moving at that certain time within those overall conditions. And then you collect all that information, we analyze it using autoregressive models, and we teach you how to do this, right? Just by sorting in Excel, right? Or even Google Docs. and finding where your win percentage is and your risk to reward that makes profit. And then when you have those numbers, then you can apply a risk percentage. Now you have your blueprint. You know what your setup looks like, when you're going to take it, what your stop loss and take profit are going to be, and what lot size you're going to use to place that trade. You know everything you need to know about that setup. And when it happens, you can push the button with confidence. Try to find somebody else that is going to tell you exactly what I just told you. It's frustrating that nobody's teaching this stuff. It's frustrating. You should be frustrated. You should feel like you got taken advantage of anytime somebody told you something different. And if you don't, just don't day trade. Because if you want to believe something otherwise, go ahead and fail. I guarantee it. 95%. If you could take a gamble at 95%, would you take it? If you were going to win that 95% of the time, you were going to win that bet. Are you going to take that bet? Yes. So if you don't do these things, if you don't backtest, if you don't figure out your money management, I bet, and I'll be right over 95% of the time, that you will lose at day trading. I want you to win. So if somebody tells you different, they're full of it. Hands down, bar none. And if you are a person that would say different, or you know somebody, I will personally on YouTube challenge that person personally. And I will show you, I will dismantle their teachings. And I've done it before. And I'll do it live. I will dismantle their teachings. And it's not because I'm some great, guru. I don't even like that word. Okay? It's not because I'm some great guru. It's just math. And it's just science. Guys, you can't fight facts. They're stubborn things. Right? You can try. 2 + 2 is still 4. No matter how you slice it or dice it, 2 + 2 is 4. Facts are stubborn things. I want you to be successful. I want you to take this information seriously. I want you to take it to heart. And I want you to learn it, even if it's not for me. I definitely want you to learn it for me, but I want you to learn it more than I want you to learn it for me. I want you to just learn it, right? Because I got a business. Of course, I want my business to continue. Of course, I want to continue to bring in people. Of course, I want to continue to have people go through my coaching and give them money to trade on so I can put my money where my mouth is and not just say that we're the best, but show that we're the best and prove it by saying we're going to put money into an account for you to trade on and let you keep the lion's share of the profit. You're going to keep 80% of that profit. Right? And I get to have thousands of traders that I keep 20% of their profitable trading. Otherwise, I just gave you money and you lost it because you didn't know what you were doing. And I'm out that money because I'm not going to go send my guys to go and collect. If you lose our money, then we just chalk it up as a loss. We don't go and try to collect it from you because we're certain of our program. That's why we can't accept everyone. Do you understand? That's not me just saying that I can't accept everyone so that people are like, oh, then I should buy it because maybe I could. No, I really can't. And it's okay. Because if any member of my team tells you that it's not a good fit, then it's not. And you should not get into our program because you'll be wasting your money, nor would we let you into our program. Right? But you should feel like, oh, thank you. I appreciate that. Sometimes that's how the conversation goes. And sometimes people are pretty upset and they say pretty messed up things. Right? And that's okay. We understand where they're coming from. Some people just want it that bad. And although we want them to have it, if it's not a good fit, sorry, it's not a good fit. You got to be okay with that. We're not just going to give our money to anybody to trade with, right? We need students, good students, right? Okay. Most day traders are using outdated indicators analysis that has not changed in decades. Doing the same thing over and over, expecting a different result is the definition of insanity, right? Trusting someone else to manage your financial future only ensures they get paid, right? That's your traditional way of investing. You're going to go give it to a hedge fund manager. You're going to put it in a 401k, a Roth IRA. You've got a big firm, big company that is managing that for you. They just use an algorithm that says, yeah, here, statistically, this is where you should invest your money. And then 2008 happens and you get wiped out. 2016 happens. You get wiped out. 2020 happens, right? And depending on when you got in or out in 2020, that could have been bad for you too, right? But guess what? The person or people or entity that you trusted to manage that money for you still got theirs. They still got paid. Even though you may have lost money, you may have broken even, whatever, they still got paid. So trusting someone else to manage your financial future only ensures that they get paid, not you. The year is 2021. Advancements in tech allow us to do things better, faster, and more profitable. This is 2021, guys. I'm going to show you guys what we have that makes day trading simple. Again, not easy. You got to backtest, right? The 7-10 hours, it's boring. Not for me, I love it, but most people are like, this is boring, it's mundane, monotonous. I get it. Maybe, but I don't know, I like it. I like finding those new things. Most people, it's boring. Okay, be bored for 10 hours. After a while, you get faster and faster at it. So be bored for 10 hours. I mean, I'm sure you're just most of you guys are just thrilled to go to work, right? You're never bored at work. If you culminate all those, be bored for 10 hours, and then you can trade an hour, 2 hours max a day, and then enjoy life. There's a concept, right? You don't want to take a 9 to 5 and replace it with another 9 to 5. If it pays more, yeah, you might make that exchange, right? Okay, I'm not going to work this job and work this job because it pays more, and it's significantly more. But what if you could exchange your 9 to 5, right? Let's just say that all day trading could do for you is just replace what you're currently making right now. That's it. No more, no less. Just replace what you're currently making right now. But versus doing that in a 40, 50-hour a week job, 60-hour a week for some of us when we did that, you could do it in an hour a day, 5 days a week. So 5 hours a week. And you're just making the exact same. Would it be worth it to day trade? Would it be valuable? Somebody, can I get an amen? I feel like I'm talking to myself over here. Would it be valuable to you? Take your time. I'll wait. I feel like you guys are asleep. Yes, thank you, Alan. Yes, it would. For the rest of you guys, it wouldn't be valuable to work 5 hours to make the same you make in 45, 50 hours, 60 hours. That's not valuable for you. I'm not even saying you can do that. I'm just saying, would it be valuable if you could? Right? Don't be shy. Don't go to sleep on me. I still got some good stuff for you. Okay. Of course, Sergio says, of course, right? It's a rhetorical question. No, it wasn't in that case, but it should be. Of course, that would be valuable. Because when you're on your deathbed, you don't think about, oh, I should have made more money. Oh, I should have bought that house. I should have bought that car. No, it's like I should have spent time with people that I love. I should have went and traveled. I should have enjoyed life more, right? Because we always think, well, in the future, we'll get to a place where we can enjoy life more. Well, later. Well, you know, it's always later. It's never now. It's never right now. And we always think that things are going to be better later in the future, right? Well, don't just think it. Do it. Make it happen. Make it happen. I'm not saying with day trading, with anything. I'm not saying it has to be with day trading. Maybe this is not the vehicle for you. Make it happen. But I'm telling you, when you're on your deathbed, I mean, I don't know. I've never been on my death. Well, actually, kind of, and I'll explain that story later. But you know, people on their deathbed, you never hear them talking about, oh man, I wish I would have, you know, made more money. I wish my house was bigger. I wish I would have got those rims on my car. I wish I would have had a bigger television. No, man, the regrets are real. You know, I wish I would have mended these relationships, spent more time with my kids and my grandkids, or I wish I would have went and saw the world. I wish I would have traveled, spent more time on the beach doing nothing, reading, whatever, right? Helping the sick and the poor and the needy, whatever it might be that you can't do, that you want to do, your heart's desire, those things, right? Those are the things that you should strive for. And if you see a vehicle that can get you there, you should look into it, but be smart about it, right? Okay. So let's debunk some things. I'm going to put a flat tire into some of these things that people believe that is just absolute garbage. It's nonsense. But again, you don't know what you don't know. So you don't have that excuse after this. You can't get duped, right? And it's not because I said so. You'll see the math. Okay. But here's how people try to spin it. Look at me. I got 1,000 pips. I got, you know, I bought this stock at this price and I got out here, or I got into the futures, you know, and I get all these different, buy my program, right? You guys have seen it a million times. Okay. So what is worth more, 100 pips or 10 pips? Right. We're talking about Forex, so we're going to stay on that topic. What's worth more, 100 pips or 10 pips? Okay. Well, the answer is it depends. It depends. So what does it depend on? Let's use some examples here. So let's say we have a $10,000 account and we've taken 10 trades and won at 70%. Okay. Our risk to reward is 2 to 1. So that means that we're risking 200 pips to make 100 pips, which we know because we talked about it earlier. 70% with a 2 to 1 would make profit. We would make profit with this. Even though we have 200 pips loss and 100 pips gain, 30% of the time we would lose 200, 70% of the time we'd make 100, and that would equal profit. We're only going to risk 1% of our $10,000 account, which is how much? $100. Okay. Now our second trade is pretty much the same, except it's only a 20 pip stop loss instead of 200, and a 10 pip take profit instead of 100. But the risk is the same, 1% risk, and the goal for each of these, 100 pips for that one and 10 pips for that one. Okay. Now trade one. We have a lot size of 0.05. Why? Because we just decided that 0.05 is 50 cents per pip. We didn't just decide that. 1% we said we were going to allocate because we have a 70% win rate with a 2 to 1 risk to reward ratio. That means that we have the probability of back-to-back losers up to 5 back-to-back losers. After that, it becomes a mathematical improbability, right? So if I know that I can hit 5 back-to-back losers, that it's a probability, then I will hit 5 back-to-back losers at some point. So I'm going to plan for it from the beginning, begin with the end in mind. So I'm only going to risk 1% of my account because I don't want to get so far in the dirt that psychologically or otherwise it's difficult for me to dig out, right? I want to keep things at an even keel. So I'm risking 1% of my account, 70% win rate, 2 to 1 ratio. That means that $100, which is 1% of 10,000, right? At 200 pips is 50 cents a pip. So 50 cents per pip, 200 times is $100. You guys follow me? Okay. So I won 7 trades for 100 pips, which was my goal, right? So I have 700 pips. I lost 3 trades for 200 pips. So I lost 600 pips. My net pip is 100 pips, 700 minus 600. So I made profit, right? 100 pips. Now, what was my profit at? 50 cents a pip, right? So what's 50 cents 100 times? $50, right? Okay. So I made $50 on those 10 trades. Maybe it took me a day, maybe it took me 2 days, but I made $50 on those 10 trades at 70% for that one trade setup, right? So to put it in perspective, you could have this trade setup and 2 other trade setups. So maybe for the day you make 250 or 100 or 50 or 350 or 5, but I should point out that after each winning trade, obviously your balance increases, so the percentage would be more. We're not looking at it that way. I want to be clear about that. We're not looking at the compounding effect that would actually cause for you to make more than just $50 in this set of 10 trades. We just want to look at it flat just so that everyone can stay on point and on key here. By the way, no one can ever give you a projection. It's not like rule of 42 or anything like that in terms of compounding, because you don't know where the losers are going to be. So there's no way to calculate where you would adjust back or forth on your lot size based on your risk percentage, right? You would have to just look at how it played out and then figure it out from there, right? But you can create an estimate, but nothing's going to be accurate. So I say all that to say this: we're just going to look at it as flat. As we're just going to say 1% of $10,000 is $100, and that's what we're going to be risking on each of these trades, right? Which, by the way, I want to point that out. It wouldn't be accurate on any real scenario, because the number would actually be bigger. This number would actually be larger for profit. But this is just an example to show you that which one is worth more, 10 pips or 100 pips, right? And regardless of what the profit is in dollars, the pip value, the amount of pips that you make would be the same. Okay, so let's look at our next example. Here we have a 20 pip stop loss, same 1% risk of that 10,000, so it's still $100 risk, right? But now it's in 20 pips. So that means $5 per pip instead of 50 cents, 20 times equals $100. So now we're using a 0.5 lot size, which is $5 per pip or 50 cents per micro pip, right? Okay, and we took 10 trades. So 7 of them won because we won at 70% for 10 pips, because that was our goal, 10 pips. So we had 70 pips. 3 of them lost for 20, so we have negative 60. Net pips is 10. 10 pips, $5 a pip equals how much? 50 bucks. Okay? This is where the wool gets pulled over on you. Remember this stuff. Okay? Don't let somebody fool you with this stuff. Look, goal 100 pips. Goal 10 pips. Profit 50 bucks. Profit 50 bucks. Same thing. It's the same thing. So does it matter if I take 100 pips or 10 pips or 1 pip or 2 pips? No, it's the same thing. Don't get caught up in having to get more movement, right? Here's the other thing. If I can take 5 trades for 10 pips in one day, but only take 1 to 2 trades for 100 pips in a week, so in 1 week, I can take 2 trades for say 100 pips, because that much movement, obviously you're going to need more time to get in and out of those trades, believe me, right? You're not going to always see those setups, and you'd be lucky if you got them twice a week, right? So let's say you took 2 trades twice a week for 100 pips. So that's 200 pips. You won them both. But I took 5, or let's just say 2 trades a day. Let's just say we only took 2 trades a day for 10 pips. So then I took 10 trades at the end of that week for 10 pips, right? Which one is worth more? The trade where I can get in and out quicker and make more of them. If I can get 10 trades, each of those trades are worth the exact same amount each of the other trades. One 10 pip trade is the same as one 100 pip trade, but I can only take 2 of that 100 pip trade. So I only get 2 of those trades, where this 10 pip trade I can take really often, so I can get 4 or 5 of those in a day, or just 2 if we're saying just 2. So then one day I get 2, right? That's equivalent to what I did in the 100 pip trade over a week. So what's worth more? Well, it depends, right? In one situation, this situation, the 10 pip would actually be worth more, even though the profit is the exact same, because I can take it more often. I get more opportunities to enter that trade. And if all is the same, 70%, 2 to 1, 1% risk, then the profit on each of those trades is going to be the same as 100 pips. So it doesn't matter if you get 100 pips or 10 pips. It can be worth the same amount, because it's still 1%. It could be 1,000 pips and 2 pips. It doesn't matter. You're still only risking 1%, right? That's money management. Don't let somebody fool you and say, oh, look, I can get more pips than that person. So doesn't mean you're making more money, right? Because I can do the same in 1 pip or 10 pips or whatever, right? Okay. So that's the first thing. So again, so does more movement equal more profit? It depends. More movement doesn't always equal more profit. Now, if we had, let's say, risking, 2% on this 100 pips and 1% on this 10 pips, then yes, that would be worth more. But if we risk 2% on this 10 pips and 1% on this 100 pips, then the 10 pips would be worth more, right? So it depends. Okay. All right. Here's the next thing. What is worth more, 90% win rate or 70% win rate? Would it be worth more if I won 90% of my trades, or would it be worth more if I won 70% of my trades? Right? So again, same thing. It depends. And you guys might be scratching your head like, how does that depend? This is where most people get tricked. I hope you're taking notes, man. I hope, because I love it when my students go and call out other people that are trying to peddle garbage. Those people are despicable. They know that their stuff doesn't work. I almost said a swear word. Caught myself. They know their stuff doesn't work. But they know they can trick you because you don't know what you don't know. Well, now you know. I'm going to show you. Check it out. Hold on. Buckle up. Here's our 2 trades. We have same $10,000 account, 10 trades. Our trade 1 parameter, 90%. We win 90% with a 5 to 1 risk reward. That means our stop loss is 50 pips. Our take profit is 10 pips. Now, because we're winning at 90%, we can actually risk up to 4% on this trade because the probability of back-to-back losers is low. Okay, but we're going to just keep it conservative, 2%. 2% with a 5-to-1 ratio, 90% win rate. Our goal is 10 pips. Our stop loss is 50 pips. Trade 2 parameters, 70% win rate, right? If you guys are counting, that's 20% less winning trades. We're going to use a 1-to-1 ratio, 10 pip stop loss, 10 pip take profit. Because of the probability of back-to-back losers, we're only going to risk 1%. Actually, we could probably risk up to 2.5 to 3% on this because it's only a 1-to-1 ratio, but we'll just keep it conservative. 1%, which is half of what we're risking here, right? Okay, our goal is 10 pips. Goal is 10 pips. Those are both the same. All right. Trade number 1. 90%. We're risking 2% of our $10,000 account. So on this trade, we're risking $200. Okay. So if we're going to risk $200 in 50 pips, which is our stop loss, then $4 per pip 50 times equals $200. So we're going to use a 0.4 lot size, which is $4 per pip. Okay. So we take 10 trades and 9 of them win for 10 pips. That was our goal. So we have 90 pips. We only have 1 loser for 50 pips. So that's negative 50. Net pips, 40. We have 40 net pips, right? After our winners and losers. Our lot size is 0.4 lots, which is $4 per pip, 40 pips, $160, 40 times 4, right? $160. That's our profit. Okay, let's go to our second one. All right, 70%, 1-to-1 ratio. We're risking 1%. 1% of 10,000 is $100. If we're only going 10 pips, that means 1.0 lot size, which would be $10 per pip, 10 times equals $100. So our lot size is 1.0. Again, do you guys see? This is not my opinion. I'm not just saying 1.0 because it suits me. It's because the math says we can only use 1%, or the math says we can only use, we're going to use 1%. We're going to use 2%, right? But we're not going to use, something that we can't, that's not going to equal profit, right? But I'm going to show you how some of these things will change the outcome of your profitability. Okay. So we took 7 trades and we won, we took 10 trades and we won 7 of them for 10 pips, right? So we have 70 pips of profit. 3 of them we lost for 10 pips. So we have negative 30. Net pips, 40. 40 net pips, right? 40 times $10 per pip is what? 400, right? Not because I said so, it's just math. Let's look at the side by side. What do we got here? 90% win rate, 70% win rate. We took 10 pips on both of those trades, 5-to-1 risk reward, 1-to-1 risk reward. Net pips, 40. Net pips, 40. They're both the same, right? But how did I make $160 there and $400 there? This one has a 20% less win percentage. It's the risk to reward. Both of them are profitable. What did I say? They both win, right? You can win at 50 and 55%. You can win at 40 and 30 and 20%. You can still win at those, right? You just have to have money management, right? Okay, so they both are profitable. So again, if you're using something that's profitable and it works, good, you're good, right? What do you need me for? If you're not and you don't know how to come to that profitability, you need to know these things. But now you can't be fooled by somebody saying, well, we win at 90%, come and sign up with us. Because that, even if they're winning at 90%, they could still be losing money, by the way. They can win 99% of their trades and still lose money. Figure that one out. Same math, risk to reward. Risk to reward says if you're going to be profitable or not at that win percentage. So what you say, okay, well, then I'm just going to make it I'm just going to decide that I'm just going to tighten up my stop loss and my take profit. Because if I'm winning at 90% and I use a 1-to-1 risk to reward ratio, well, that's going to be way more profitable. Well, yeah, but are you going to win 90% if you're stopping your trades out at a 1-to-1 risk to reward ratio? No, that's probably not going to be the case, right? And you don't just get to decide that. Your back testing tells you what it is. You guys making the correlation here? You got a blueprint first. Back test so it tells you what your win percentage is at what your risk to reward ratio is. And then use it. Who cares if it's 90% or 70%? Who cares if it's 40%? right? Who cares? It makes profit. Use it, right? I hope you guys are understanding this. By the way, it takes the same level of psychology to trade at 90% as it would to trade at a lower win percentage, let's say 50%. The same psychology. Because at 50%, you have to get used to having a lot of losers. And that takes a psychological facet that says, okay, I got to get used to this. And if you can't, then you start getting emotional. You start trying to revenge trade. And if you don't know where you are, okay, imagine you don't know that you win 50% of your trades, and you're using a 1 to 3, which is good, right? You don't know that that'll equal profit, and you've just taken 6 losers in a row, right? You know that you took 6 losers in a row. You know, today you put in 2 trades, you lost them both. Tomorrow you put in 2 trades, you lost them both. You took a hiatus the next day. The following day you come back, you lost both of those. You lost 6 trades over the course of 3-4 days, right? You're starting to question whether or not you know how to trade. Your psychology is jacked. You start putting in stupid, dumb things. You start looking at YouTube videos, and anything anyone says, you think that's got to be better than what I'm doing. You try to do it, and you make the situation worse and worse and worse until you're out of money, and now you have a choice. Re-up, put more money in, or go back to the drawing board and figure it out, right? Okay, so people have not backtested. What did I say? We backtest for 5 years. How long did I say that it takes the average day trader to become successful? 5 to 7 years. You can look that information up, by the way. I'm not making that up. Why? Because they front test, they don't back test. They go into the market with real money and they lose it, and they realize I got to go back to the drawing board. And then they do it again and again and again. And after 5 years or 7 years of going through all the different overall market conditions, they then realize, oh, this is the balance of it. After all my looking at all my trading history, this is the balance of it, right? But only less than 5% of people do that. Less than 5% of people do that after 5 to 7 years, after wasting all that money, losing it in the market. Most people just quit, by the way, right? And some make it to that 5 to 7 year mark and then say, okay, I finally figured it out, right? And then from that point, they're profitable, not rich. So then it takes another 2 years, 1 to 3 years to then become, financially secure, whatever that may mean for that individual, right? Replace your income, build wealth, things like that. So 10 years, and in that process, you lost a whole bunch of money because you've got to go back into the market. And normally people won't do it. They won't continue to re-up, right? Okay, so again, I talked to, a matter of fact, I'll tell you, sorry, one of my friends, he says that he's divorced and his kids don't talk to him anymore because of day trading, right? Obviously, there's probably more to the story than that, but the way he tells it makes sense. They think he's a compulsive gambler because it took him 6 years, right, to figure it out. And he was selling stuff. He mortgaged his house. He sold his truck. He, a lot of it drained their life's, savings, drained 401ks because, he figured, I got to figure it out now. Put money in the market, lose it. Oh, no, now I got to figure it out. Put money in the market, lose it. So he lost his wife, he lost his kids, and he says it's because of that, right? But then he figured it out. And now he's a multimillionaire, okay? Of course, I asked him just like I said I did, right? I asked all of them, would you use my program? And of course, the answer is always the same. No, I've already figured it. It took me 7 years, and then it took me, another 3-4 years to get to where I am, to where I broke 6-7 figures, right? I've got to figure it out. I don't want anything to mess up my process. This is my process. I don't need anything else, right? So again, I asked him, well, what if you could go back to day one? Well, of course I would. Of course I would use your program day one, right? Because you just cut out all that frustration, hassle, things that I didn't know. Well, why doesn't anybody know this? Because no one's teaching it. And let me tell you why a lot of these people out there are not teaching it. Because if over 95% of individuals fail at day trading, is because over 95% of the information out there is garbage. Garbage. And I will say that to the face of anyone that you put in front of me if it is garbage. And I'm telling you, I will dismantle their whole process. And it's not because it's my opinion. It's not. It's just because that's how it plays out. Because they're not using this kind of stuff. And they don't teach you this kind of stuff. And some of them know they're not teaching you this kind of stuff, because if you knew this kind of stuff, then you would see that what they're teaching is garbage. You would know how to prove that their stuff is garbage. Do you see what I'm saying here? They're selling you a hoop dream because it can work. Their stuff can work, right? You don't have to take 5 to 7 years to figure it out. You can back test that stuff, right? Price action, all that stuff, right? But you're trading now at 50 and 55% win rates, which means your risk percentage is going to be much lower, which means you're going to have to either start with a really big balance, right, in order to make anything significant, or you're going to have to build up your small balance over a long period of time, which will still take 3, 4, 5 years. So why do we offer what we offer? Coaching, right? Because we want to teach you the right way so you don't take 5 to 7 years to figure it out. We want to teach you back testing, right? We want to teach you money management. We want to teach you risk reward, risk percentage, right? And then we want to give you a big, fat, hefty account to trade on so that you have the best of both of those worlds so that you can get to financial freedom a lot sooner than anyone else. It's the difference between taking a horse and buggy from New York to California or taking a jet plane. That's the difference. It's not just faster, it is exponentially faster. And 95% of people that choose the horse and buggy fail. They don't make it there. They die before they get there. Their accounts are busted, they're divorced, or whatever, and they're out of the game, right? The other 5% do make it there. They take the Oregon Trail, right? And they're there. They make it, right? But it takes a whole lot longer than taking that jet plane. Today, right now, what do we say? It's 2021. This is not, the frontier, right? This is not the Wild West. We don't use horse and buggy. We have technology. Let's use that technology to get us there faster, right? So again, it's not about just the tools that you have, okay? The tools are important, right? But if you don't even know how to get from New York to California, it doesn't matter if you have a horse and buggy or a jet plane. If you don't know how to fly a plane, it doesn't matter if you have a plane. You're not going to be able to use it. So does it really matter that I have the best indicators? Nope. It doesn't really matter if you don't know how to day trade. If you know how to day trade, if you know how to back test, you know how to figure out money management, risk reward, risk percentage, you can take anything and figure it out. There's going to be a yes somewhere in there. If you know how to collect the information, if you know how to do and it's not like you need to be a genius. I mean, you just collect points of entry and how high it went, how low it went. There's some simple things that you collect, but they're specific. You got to collect those things and then analyzing them. And analyzing is literally just taking a sheet and sorting it, sort A to Z, right? Biggest to smallest, and then figure out where your win percentage, risk percentages. And we teach you guys, we through our program, we teach people, our students, all of that, right? So now you've got the jet plane, and you've got the pilot school, right? And we fuel the sucker up for you. And we show you exactly how to get there. I can't make it any simpler. But the reason why we offer the things that we offer is because those are the chinks in the chain in the industry. Here's the problem. You don't know what you don't know. Most people that look at day trading don't know what they don't know. They don't know that win percentage has very little to do with whether or not you're profitable. More movement has very little to do with whether or not you're profitable. They don't know. Now you do. Now you know. And so somebody tries to tell you, okay, this is my setup. You know what questions to ask. Okay, what's the win rate? What's the risk reward ratio? What risk percentage? Right? And you can take a piece of paper and write it down. Okay, they said that they're taking this many pips, 10 pips, and they're not using a stop loss because that's a really popular one. And they're winning 90% of their trades. Okay, so let me just break this down for you because these are the questions that you can ask. Okay, let's say you win 9 out of 10 trades for 10 pips. Okay, let me use a different color here. You have 90 pips and you hit one loser for 100. You won 90% of your trades. Did you make money? Nope, you lost money. You can win 99% of your trades, right? 9.9, which would be 99 pips. 99% of your trades. Look, this is just math, guys. People are pulling the wool over your head. right? If I had 9.9 winning trades out of 10, that 0.1, that one loser, right, for 100 would mean I have a -1. Does it matter if somebody wins 99% of their trades? Doesn't mean they're profitable. How do you figure it out? Risk to reward. Is your stop loss in a ratio that is going to equal profit long term? Because this is not about 10 trades, right? This is about 1,000 trades, 5,000, 10,000 trades. Well, if you can't get it right in 10 trades, it's not going to be right in 1,000 trades. It's just math. What I tell you, I was going to tell you guys. I was going to let you know. I was going to let you know on their dirty little secret. It disgusts me. I hate it. I don't like it. And I love calling them out. And I love when my people call them out. I love when people go to these sessions and then they go somewhere else and they call those people out. I love it. I love it. I get these emails all the time. And it's embarrassing for those people because they're on live webinars sometimes, just like I am right now. That's why you'll notice not a lot of them will do this live thing, right? And one day I'll show you guys some videos of guys that have just absolutely trashed their accounts while they were live. And these guys were millionaires one day and broke the next. I mean, like repo within a month. Their house is gone, cars are gone, everything, right? It doesn't matter if you look, if you want this to be like Vegas and you get lucky in a few trades and you make a whole bunch of money, then quit right there, take your money and run, because it's equivalent to hitting a jackpot in Vegas. If you keep on gambling, you're going to lose it, right? Unless you have an edge, right? You're going to lose it. So you hit your jackpot, you take the money and run. If that's what day trading is, cool. It's a hobby. You're in the wrong place. Go somewhere else. But if you want to do this and build a financial future for yourself and have this skill that you could do an hour a day. I mean, some of us are down to like 15, 30 minutes a day, one trade, right? And then we're done. That's it. We don't need any more. We're good, right? Because there's things that are more important to us, right? This right here, what I'm doing, this is important to me. I love this stuff. I love this stuff. A good Saturday for me is back testing. I'm stupid like that. I love it. This is my passion, right? Some people like building model airplanes or, I don't know, fishing or whatever, RC cars, video games, whatever, day trading, back testing, money management, teaching you guys. I love this stuff. And I get to do what I love. That's it. You should be able to do what you love. All right, let's continue. So again, does higher win rate equal more money? It depends, right? Plain and simple. Okay. So what does it depend on? We've talked about this. Win rate, risk to reward, risk percentage. In other words, proper money management. Again, how do you get these numbers? How do you come to these conclusions? What your win rate, risk percentage, risk to reward, how do you get to that? Let me show you just an example. I'll show you a hardcore example. Let's see. Let's go. I know I got one in here. Where is it? I can never find anything when you're looking for, right? When you're on the spot. It's like, oh, what did I do with that? Okay, let's do it the easy way. So the person that I'm thinking about, because this was most recent that we did live. So the reason I show this one is because on the mastermind webinar that we do on Tuesday mornings, we did this live on the mastermind. So as it was 1 week at a time for 6 weeks. So as Jordan is back testing this stuff, the market is, doing its thing, right? And so you can see that now the information that we'll collect when back testing is going to be date, the pair, the direction, the time UTC, and then duration drawdown, post-trade movement, and post-trade movement duration. Okay, but he was thorough, and the more thorough, so not only did he get a solid yes as to what win percentage would be, a stop loss and take profit would be, but he got like 6 solid yeses. There's like 6 trade plans and all this information. Okay. And they're all solid, right? But he was very thorough, right? You can see his first example was January 5th, 2015. And this is for a specific time, a specific currency pair, right? He even has it broken down for spring and fall to account for that, right? And then he said, okay, when this setup happens at this specific time on this specific currency pair, I'm going to record the information. And then he put notes in here, and you can see 1/5/2015 all the way down to there's 2016, 2017, 2018, 2019, all the way 2019. So the proving ground before 2020 was January 1st, 2015 to December, the end of December 2019. But after 2020, we realized 2020 and 2015 were pretty much the same in terms of the overall condition. So we just moved it up 2016 to 2020 instead of 2015 to 2019, right? Okay, so he did this in 2020, which 2020 wasn't over yet. So he backtested 2015 to 2019, or yes, 2019. And now we're backtesting 2016 to 2020, okay? So right here, 12/31/2019 was the last example for a total of 461 examples. Okay, and he did that all by hand, okay? After we broke this down, one of them, I want to say it was like a 74% with a 1-to-1 ratio. So it wins 74% of the time. So basically all he did to analyze and get at least one answer was just take the drawdown and post-trade movement. Now there's specific ways to collect this information: duration, drawdown, post-trade movement, duration. But I mean, the quickest way to get at least one answer is just to take these 2 fields right here and sort them. That's it, right? So you would just take it and, you know, let's just copy whatever we have there and then paste it and then sort it by drawdown to start with. You want to label it and stuff, that way you can keep it in its original order, yada yada, so on and so forth. But sort it, and this is one way you can do it. There's other ways that we do it for our members, but this is a really simple way to do it, right? So now I know that trade drew down 0 and went 11.9, so on and so forth, individual trade, right? But then I can go to the bottom and say, okay, where does it really drop off, right? So drawdown 6-7, we're like 347 trades in, and the most drawdown I've had thus far is 9 pips. So let's go to the bottom. 100, there's 100. The other ones are 43 or less. So we can obviously see a really big dropout after 20. So, okay, what if we said 22, right, is our stop loss, and then our take profit, even if we did half of that, which would be 10, all we'd need is 70% of these to win with 10 pips take profit and a 20 pip stop loss. If we've got that, then we're good. We've got, you know, a 2-to-1 that we can start with, and there's probably, obviously, I know there's more than that in here, but we have a 10 pip, 20 pip stop loss, 10 pip take profit at 70% or greater. That's profitable. So now he knows, okay, if I've got a 2-to-1, and I'll show you another tool here. If I've got a 2-to-1 risk to reward, and I've got, let me just go into our member site, because I'll show you. I mean, we've got tools for everything, guys, tools for days. Let's go to resources. Risk percentage cheat sheet. So I know, so these are just some general numbers, right? But it's just a cheat sheet. 70 to 79%, I can risk 0.5% to 3% because of the probability of back-to-back losers. 80 to 83, 1 to 3%, 84 to 86, 87 to 89, 90 plus, never more than 5% risk at any time, including multiple trade scenarios. That's how you survive. That's how you win at day trading. Okay, is following some of these rules. So if he's winning, say 70% with a 2-to-1, then he's going to be on the low end of this, like 0.5% to 1% risk, right? So if he's risking 1% and he's taking that trade a couple times a day, at 70%, then 30% of those are going to lose for, let's say, what do we say, 20 pips, and 70% of them are going to win for 10 pips, right? So we've already seen this, right? 7 times 10, oops, 7 times 10 equals 70, right? And what was the other one? 3 times 20 equals 60, and that means we have a plus 10, right? So we would get 10 pips depending on, and if we're risking 1%, then what we make in those 10 pips, to answer the question, and I realize we've already answered it, but to answer the question, what are those 10 pips worth? Well, it depends on what your risk percentage is. If your risk percentage is 1%, right, then what is it 1% of? It's 1% of your account balance. 1% of your account balance. So if you have a $2,000 account, right, what's 1% of 2,000? 20 bucks, right? So that trade is worth what? If you're risking with a 2-to-1, 20 bucks, then that trade, when you win it, is worth 10 bucks, right? So what would this trade be worth if we had a $2,000 account and we were risking 1%, which is $20? So our risk would be $20 in 20 pips, right? So $1 per pip, which is a 0.1 lot size, 0.1, $1 per pip, 20 times, which is our stop loss, would equal $20, which is 1% of $2,000. Okay, so if I have a 0.1 lot size 10 times, well, that's $1 per pip times 10, so I make 10 bucks, right? And 10 bucks is 0.5% of 2,000. So I made 0.5% on those sequence trades. Now you look at your Roth IRA, your 401k, they do on a good year 8 to 12% a year. So you might scoff at 0.5% for 10 trades that you could probably take in 2 days. But that's 0.5% on your total account balance without having to feed the pig. In other words, every month you don't have to continue to put into this one. Your Roth, your 401k, all those, you have to continue to feed those every month, right? For those of you guys that have those, you guys know that. And who guarantees to get paid when you do that? The person managing that for you, not you. Joke's on us, right? Okay, now I'm going to show you guys what the data culminates to. And we have this available to our members as well. We like to get our members started. So this is a setup that we'll go over here in a little bit. This is Dirty Pressure. And here's what the data looks like. We back tested this for our members, Dirty Pressure, for every hour, so hour by hour for buy, hour by hour for sell, and only accepted things that were 70% or greater. Notice 2 a.m. Mountain Time, which is my time. Obviously, it'd be different for you. No viable trades for this setup for a sell, but there are viable trades for a buy. No viable for a buy, but there are for a sell at 4 a.m., so on and so forth. So then I could say, okay, if I'm going to take a trade at 1 a.m. Mountain Time, 6 or 7 UTC, depending on daylight savings, then I can take a 22 pip stop loss, 10 pip take profit, and win 78% of the time. So if I know I'm going to win 78%, almost 80% of the time with a 2.2 to 1, then I'm going to risk 2% on that trade. So if I risk 2% on that trade, and let's say my account is $2,000, right? $2,000, then I'm going to use a 0.18 lot size. Look at that. I don't even have to do the math. No problem, Sergio. Thanks for joining us. So I'm going to use a 0.18 lot size. And if I hit a 22 pip stop loss, that's going to equal 2% of 2,000. I don't even have to do the math, right? And there's tons of tools like this that we have. Now, this is just for the Euro USD, hour by hour for buy, hour by hour for sell. There's GBP-JPY, GBP-USD, USD Swiss franc, USD-JPY, Australian Canadian dollars, 6 different currency pairs, all with back-tested data. 78%, some of these are like, let's see, 95%, 79, 71, nothing's going to be below 70, 88%, 93%. This one was 100%, but just one loser is going to knock that down, right? So we don't count on 100%, but it hadn't lost at that point. I think we need to, let's see. Nope, this is actually from 15 to 19. January 2015 to December 2019, this was back tested. So from January 2015 to December 2019, 8 p.m. on the Euro USD Mountain Standard Time for dirty pressure didn't lose once. It will eventually, nothing's 100%, it will eventually, but from that time for 5 years, it didn't lose once, just that one, right? Just that one time for buy, right? The sell did, right? It's an 88% win rate. The setup overall obviously loses. It just so happens that at that specific hour, on that specific currency pair, on that specific setup, it hadn't lost a trade for 5 years. It doesn't mean it won't. It will eventually, but it hadn't at that point. So there's no such thing as a bet the farm trade, right? If even if it says 100%, well, you don't bet the farm, right? Why don't you bet the farm? Because it only takes one time to lose when betting the farm to lose the farm, only once. So don't bet the farm, right? Okay. Proper money management. All right. So I'm gonna go. Let's see, what time is it? Okay. We'll cover flat top if we have time. I want to show you guys. You guys feel like you need a break? It's about 1 o'clock. We took the other one at about 11:30. If you guys want a quick 5-10 minute break, we can take one. Otherwise, we can press on. Yes, no? Yes, no? All right. 5 seconds. If nobody answers, I'm going to continue. All right, let's do this. All right, go ahead, Alan. We'll take a quick 5 minute. All I needed was one for one of you guys to want it. All right, not a 10 minutes, take a 5 minutes. It's top of the hour right now for me, 1 p.m. Mountain Standard Time, so it's 3 p.m. Eastern. So let's come back at 5 after. I'm going to hang out right here, so if you guys have questions, feel free to ask.
Well, before I go, I got one question.
Yes, sir.
Is there a way just to use the indicators, or is it just a whole program in total?
Again, what good would that do you if you don't know how to day trade?
Yeah, that's true. I didn't think about that.
Yeah, that's why we talk a lot about that, and that's why we make it very clear, because we could just offer, like a lot of people do, and make tons of money, by the way. Just let people use our indicators for a monthly fee or whatever, and it's up to you. You know, whether you win or lose is up to you. But if I was just doing this for money, well, I just wouldn't do it, because I day trade. That's where I get my money, right? So I do this because I'm passionate about what I do. I feel like I've always had a passion for teaching. And so that just kind of carried into day trading. But you know what, tell you what, when you guys come back, I'll kind of recap my background. I think it'll help you guys understand kind of where we are in this process.
There's one more day tomorrow, right?
No, this is a one-day event.
Oh, okay. So I thought I got an email. Oh, so you'll go over pricing at the end?
Yeah, we're going to go over the Trader Lite program at here in just a little bit.
Okay. All right. Thank you.
Yes, sir. All right, let's get cracking. Okay, so I'm just going to give you a big, quick backstory on me. So I grew up in Tucson, Arizona, rough neighborhood. What you would call like a disenfranchised area, right? Southern Arizona. And just to give you an idea, so I grew up for those of you guys that are familiar with Tucson, I grew up on around 12th and Valencia. And 12th and Valencia, each of those corners represented a gang, and they were all rival gangs. So there was a lot of drugs, a lot of gangs, a lot of violence, a lot of crime. In the 90s, when I grew up there per capita, we had a higher homicide rate than New York, just to give you an idea. So it was rough. It was difficult. My parents didn't have a lot of money. My dad, he was a serial entrepreneur, and sometimes when you're building a business, You know, you don't know what you don't know, and there were things that he didn't know. He was motivated to do to get things started, you know. So he started a fence construction masonry business. Didn't have the right licensing. Ended up getting this lady kind of ran a scam on him where her and her neighbor had a wall built, a brick wall built, and then they chose not to pay him when the job was done. And he tried to take them to court, and they argued that he didn't have the correct licensing. The court ruled in her and her neighbor's favor, and my dad was out a whole bunch of money. Being a new business, he struggled to stay afloat after taking that hit. Eventually had to bury that business. Later on, got some capital, started a new one. Obviously, made some changes to the business, and you know, some downfall in economy and things like that kind of hurt his business. Ended up having to cash out on that business as well. Didn't hurt as bad on that next one, but then he, you know, became a truck driver. But in that process, we went homeless. We were in a homeless shelter. At that point, my sisters were old enough, and they had left the house, and it was me and my younger brother. So I got 3 siblings total, and we lived in a homeless shelter. You know, we were poor. We didn't have, you know, we had hand-me-downs and secondhand stores type stuff. You know, we sometimes we didn't have a vehicle. Sometimes we didn't have furniture in our house, right? It was hard times. But if there's one thing that my dad taught me was to work. And ever since I was 11 years old, summers I'd work with my dad. You know, and after a while I ran a crew for him. So I would have my own crew, and, you know, when I was 16, and we'd go out to job sites and I would be running the crew, right? So I did a lot of work, manual labor, and I loved it. I liked that kind of work, and I still miss it even now. But when I was 22, I had my wife and my firstborn son. He was 2 years old, and I got in a car accident. And I compound fractured my left leg. So not to be graphic, but my knee came out the back of my left leg, so it was L-shaped the wrong direction, and I cut my femoral artery. I was laying under the truck for a really long time. It rolled and landed on top of me. My leg got caught in the steering wheel. The force of the truck landing on top of me snapped my left leg in half. I should have bled out, but the car was laying on me. The truck was laying on me in a way that cut my circulation off. I was under there for a good 6 or 8 hours in a very rural area. It's called Amado, Arizona, in between. So I was on the road in between Arivaca, Arizona, and Amado, Arizona, which is like 20 minutes, just a stone throw away from the Mexican-U.S. border. And a buddy of mine was with me. He walked away from the scene, but people don't stop when they're driving that small road, because there's a lot of illegal immigrants that cross there because the borders are really lax. I mean, literally, I can go in my truck and look in the distance and see 3 strands of barbed wire that separated Mexico from the Arizona border, the U.S.-Arizona border. 3 strands of barbed wire was all that was there. So there was a lot of crime and things. So people wouldn't stop because they would get, you know, they would get their car stolen, they'd get, you know, murdered, bad stuff would happen. So my buddy standing in the middle of the road trying to flag down a car, which there were very few, by the way, wouldn't stop. So finally, he just kind of stood right in the middle. And these people are going like 50, 60 miles an hour on this 2-lane road. And they slowed down just enough so he can let them know that we got in a car accident, and let them know, hey, take a mark of the mile marker. When you get to the town, you know, this is, you know, although there were cell phones, there wasn't a lot of good reception out there. So they had to get to the next town, which is a small town, Arivaca, and call from a landline or a payphone. And it would, from that point, it was probably about 15 minutes to the town. So they called, and we just sat there and waited. I was in and out of consciousness. He was panicking. And finally, the Rio Rico Fire Department came out and started the rescue. Border Patrol came out and was assisting in the rescue. Anyway, I ended up getting airvac to Tucson, to Tucson Medical Center, or sorry, University Medical Center. And I went into surgery to reconstruct my knee. So they had, you know, tourniqueted the bleeding and stuff, and now they needed to try to put my knee back together. And after about, you know, 7-8 hours of surgery, they came out and told my wife that they were gonna have to cut my left leg off. And she basically told them, you don't know him. If you cut his left leg off, you're not gonna want to be around when he wakes up. So the doctor, the surgeon turned back around, went into the room, and went to town on my leg, and it took him closer to 17 or 18 hours before he was done. I had rods going into my leg, an external fixator to hold my leg and my knee in place. They'd taken a vein graft from my right leg and grafted it onto my left leg where my femoral artery had ripped, going through my pelvis. So I wake up after 18 hours of surgery, and I've got this like 120-pound nurse on me. And mind you, my pelvis was fractured, and they had just drilled a hole in it where they needed to graft, the femoral artery. And she's pressing down on my pelvis, my fractured pelvis, as I wake up, because you need to do that to clot the bleeding after surgery. Well, I guess I woke up a little too soon, and I just basically threw her off of me. And as I did, because I woke up and I was in excruciating pain all of a sudden, threw her off of me, and this arch of blood is just shooting out of my pelvis. Anyway, so got that all under control, and I was in ICU for about a week. And after ICU, I went to a regular room, and this is how I found out that I was going to be paralyzed for the rest of my life. The doctor came in and said, so you're going to have to make some adjustments where your disability is permanent. At that point, I knew that I didn't have any sensation from mid-thigh down, but it kind of worked its way slowly. My feet went numb, then my legs, parts of my legs, and then it stopped about mid-thigh. But I didn't know that it was permanent. I just, I wasn't sure what was going on, and nobody had discussed that with me. So that's kind of how I found out. Kind of lost my mind for a moment. Had to sit there and pray and meditate for a while, and I felt comforted after that. And so I was good, and I recognized what my situation was, and I needed to, be strong and adapt because I have a son and a wife that count on me. Well, my parents had, at that point, I was out of the house, and they had begun truck driving together, and they had moved to Utah because that's where their trucking company was based, the company that they worked for. And when they shut down, they weren't on the road. They wanted to shut down. They wanted to live in the same place where they shut down. So I couldn't do what I used to do, and so I had to move in with them. Well, my dad, Force Recon Marine, did 2 tours in Vietnam. He's hard-headed. God rest his soul. Passed away, some years ago now. But we didn't get along very well, right? I mean, we're both hard-headed, stubborn men in the same house, and so we butted heads. And so, but I had to be there because I was on bed rest, could barely move myself around. But after 6 months, I was feeling good enough that I could go and get a job. So I went and got the first job that I could get, which was a call center job. And it was in market research. Now, it sounds fancy, but you guys know these people. They're the people that call you and say, hey, do you want to do a survey for 45 minutes for free, right? That's what I did. I would call people to do surveys on the phone. And it was a tough job, but I realized that there was this big conversion, right? I mean, the people that I trained with within a week were gone because the job sucked. It was hard. It was difficult. Mentally, right? People swearing at you and not wanting to do your surveys. And so the attrition, the retention of people was terrible. People would just quit on a regular basis. So they were always doing these training groups. Well, I realized, if all these people are quitting, then I'm probably going to be able to move up pretty quickly if I just stay, if I just stick it out. So I didn't just stick it out. I did really well at it. I was able to convince people to do, more surveys than most people. And when a manager position came available, I applied for it and became a manager. And then about a year and a half after that, the company outsourced to overseas. So they shut down our organization. And I went to another call center in the same industry on a referral, worked for them. That company went out of business. 2 more companies that I went to on a referral went out of business as well. So this is 4 total, okay? You would think, well, maybe just do the call center thing, but just in a different industry. But I realized there's something here. If I could stick this out, there's something here. And so the next company I got recruited to, they made me the manager over operations. And so I worked there and eventually worked my way up to getting to a point where I was running the whole organization after 4 years. I was I called myself general manager, but I was basically the CEO. The owner, this was his test lab, basically, genius man, inventor, and he was working on, at the time, a predictive dialer that was the best in the business and actually sold it for a whole bunch of money later. But he said, you know, this is your ship. Do with it what you will. I trust you. And so I did. But after I ended up later getting a divorce, and my heart wasn't in it anymore. I wanted to work for myself. I felt like I had that entrepreneurial mindset that my dad did. So I went off on my own. I realized I've not only seen how this industry and these companies have failed, but I've seen them succeed, and I've been an integral part of that success. So I want to teach people how to be successful in these call centers. So it wasn't difficult to find clients. So I was able to find clients, but I worked a lot of hours, 60, 70 hours a week. Weekends I would have, I'd be going to clients part-time, so I didn't have a lot of time. But that's when my business partner now, he's a friend of mine at the time. It's obviously still is a friend of mine, introduced me to day trading. And because of my market research background, I realized that we could create these predictive models for back testing instead of just kind of having at it the old-fashioned way that was really long and arduous and doesn't really give you the best answer, just unanswer, a yes or a no proposition. But eventually you'd come to a yes proposition. It may not be the best yes proposition, but it is a yes proposition. And so we realized there's a better way of doing this. There's a more scientific and mathematical way of doing it. And that's why we developed the golden ratio analysis. And it works exponentially better than any other back testing method. But it uses that same concept of autoregressive model to give you a prediction as to how that is going to play out in the future. And it works very, very well, extremely well. Matter of fact, the data that I was showing you guys earlier for Jordan, we finished that lesson, and you guys, and for those of you guys that even join our light trial, I can show you those lessons. But you can follow through, and on the 6th lesson, which is 6 weeks later, he had finished his back testing. We analyzed it, and that's when we came up with that 74% win rate with a 1-to-1 ratio, whatever it was. Well, back testing it from 15 to 19, 2019, and then testing our parameters, the stop loss and take profit, from January 2020 to that date in August, it would have, if he'd have been trading with those parameters from January to August, this is how accurate this was, he would have hit exactly 74%, which is exactly what he tested for. That's what he back tested for. From 2015 to 2019, got 74% with this stop loss and this take profit. And in 2020, to that very day, he got 74% with that stop loss and take profit on that currency pair with that setup. So it is accurate, very, very accurate. But that's what lent to that aspect. Tim had the know-how of day trading, right? Of the intricacies of the market, leverage, risk, stop loss and take profit, getting into trades, reading the indicators, right? Using the tools. And so we just put our two know-hows together, and Day Trade Smart was born. Matter of fact, I'll tell you a funny thing. It was actually Cash Trading Group first, KASH Trading Group. And we brought in a consultant, and he's like, have you ever considered changing your name? We're like, well, yeah, because, we got to always explain it, cash with a K. He says, actually, that's not what I'm concerned about. And we're like, well, what do you mean? He says, well, when you say it fast, it doesn't sound like Cash Trading Group. It sounds like Castrating Group. And we're like, oh, yeah, we don't want to be Castrating Group. So we changed it to Day Trade Smart, because that's what we do. And that's our slogan, right? Day Trade Smart. That's what we do. We day trade smart. We're not the only ones, right? But there are very few of us. I guarantee that. And those of you guys that have looked around, you can attest to that. But that's just a little bit about me. And at some point you'll hopefully be able to hear, Tim's story and how he came to day trade. But you get to a point where if you don't have to work anymore, what do you do with your time? Right. And so, you sit around, and I've worked since I was, a real job. I mean, in the summers I worked with my dad at 11. I've always had a job. I've always had something to do. So not doing anything and only working an hour a day just wasn't jiving with me, right? Trading an hour a day and then being done. Eventually 30 minutes a day, sometimes it's just like five to 15 minutes. So, you know, when we built this, it was like, okay, we have something to give to this, not just develop a system, get people trained up, and then recruit from those people and have them teach other people to duplicate our efforts, right? Because our coaches go through our program and they're successful and they have a heart to teach, and we recruit them. We ask a lot of people within our organization if they want to teach. Not everyone says yes, but the ones that do, it's because they have a heart to teach. And those are the ones that we have them teach other people how to day trade, right? They're professional day traders that teach other people how to be professional day traders. But then what do? We just sit around and do nothing? No. So we take a very forward approach in our business. When people get set up with onboardings, we'll do a lot of those onboardings. When we do one-on-one sessions with people during our Trader Lite program, we'll do those sessions, right? We want to get to know as many people as we can. We want to be available. We don't want to be off in the distance and not accessible. We are passionate about this. It's not work for us. So we're not bothered by our members wanting to ask questions or engage with us. We want to engage with you. We don't want you to trade as good as us. We want you to trade better than us. There has to be an evolution. Otherwise, what are we doing, right? We want to bring in people that are at some point going to be better than we are, and then people that later will be better than they are, and so on and so forth and so on, and always get better. So we're always introducing new innovative ways to become more proficient, you know, and do it in a more expedient amount of time, because we realize that the real need is to have more time freedom. And you don't have time freedom if you're tied down to a 9 to 5. You don't have time freedom if you're grinding it out just to make ends meet. But if you can make money and do it in a short amount of time, then that gives you financial freedom, which in exchange gives you time freedom. But not always, right? Sometimes you can have financial freedom, but work until you're blue in the face, right? 50, 60, 70 hours a week. You don't get to enjoy life. You have financial freedom, but you don't have time freedom. So that's just a little bit of backlog on us. Let's continue here. All right, and of course, feel free to ask questions. So I'm going to show you guys dirty pressure. And I'm not going to read that. I'm just going to show it to you guys. Okay, so this is kind of what we were alluding to earlier with dirty pressure. When I was showing you guys the follow-ups to that hiccup pattern, I was pointing out some of those dirty pressure setups. So I'll show you what that is. So I'll teach you that right now. So what I'm going to do is I'm going to use two charts. I'm going to use this chart. We're just going to look at the euro versus US dollar just to make it easy. And I'm going to use another chart. Notice how sometimes these lines, you'll notice that sometimes these lines get really close together on the bottom, those pressure lines, right? They get really tight, like right here. So part of this setup is we want to see when these lines intersect, when they cross. So for example, so this is the same as this. And if I move one chart, both of them move together. Okay, but I just have this one stretched out so we can see these lines clear. Okay. I mean, I could just do it here, but then I'd have to continue to do it and then stretch it back. So I want to just be efficient. Okay, I want to see when that line crosses. When it crosses on bottom of red, like that, so you can see right here on this candle, right? This candle right here, it's on top of red. Okay, green is on top. And this next candle, very next candle, it's now on bottom of red. It crossed below red. I want to see that cross. And when that happens, on the same candle, I want to see all four of these lines already pointed down. Okay, and when that, it doesn't matter where they are, overbought, oversold in the channel, as long as all four of those lines are pointed down. And then at the end of that candle, we'd sell. So green crosses on bottom, all four lines pointed down, we short or we sell. Okay, and then when green crosses on top, so if it was already on bottom, let's find. So when green crosses on top, like that, I want to see all four of these lines then pointed up. and then we'll take a long or a buy trade. Okay. So let's use the same parameters we were using before, because of course it doesn't matter, because we're not looking at back testing. We're just going to have something to shoot for. That's all. Okay. So first thing is I want to see that green line cross on top of the red line. And then when it does, then I'm going to look up to see if these are pointed up. Okay. So still on bottom. Okay. So right there, green is now on top. We can see it clearer right there, right? And all four of these lines are pointed up. So right there, we would take a long or a buy trade at the end of this candle. This is a 60-minute candle. Can you use this on a different time frame? Yeah, of course. You can use 5-minute, 30-minute. It's going to work differently, right? Different parameters based on back testing, but we're just going to use a 60-minute. Okay, so right here would be my entry at the end of that candle, 1.20720. So if we're going for 5 pips, then that would be 1.20770 would be my take profit, 1.20770. And my stop loss would be 1.20620. 620. And there's a stop loss. So obviously, we want to see, will this go up to that blue line before it goes down to that red line? If it does, then we win. If it goes down to the red line first, then we lose, right? So let's click forward. It did both. Okay. Let's see which one went first. Excuse me. So I'm going to use a 5-minute chart. And again, just like before, this is in 5-minute increments. Each of these candles is 5 minutes of what happens in this 60-minute, right? So this candle right here is the last 5 minutes of this 60-minute candle. This is what happened in the last 5 minutes of that 60-minute candle. Okay. So if I click forward one on this chart, then we're going to see the first 5 minutes of this 60-minute candle. And then 2 would be first 10 minutes, so on and so forth, right? So right here, I want to see, did the market go up to 5 pips before going down to 10 pips? So let's see what happened in the first 5 minutes. Maybe not enough. That only went down 4.5. Yeah, it went up 6 pips. In the first 5 minutes, it went 6 pips up and only went 4.5 pips down. So the first 5 minutes of this candle went up 6 pips, then down 4.5 pips, and then whatever else it would do after that, right? So did we win that trade? Yes, because the first 5 minutes went up, would have went past our take profit, and then came down. So even though it went both directions after that 60 minutes, we would have been out of that trade already before it went down to 10 pips. Okay, so let's look for another one. And we'll validate them. If any of them are close like that, we'll look at to see which one went first. Okay, so green is on top. Now we just want to wait for that green line to cross on bottom of the red line. And then when it does, we want to see all 4 of those lines pointed down. Okay, so and I think it happens on this next candle right here. Yeah, so green is now on bottom and all 4 of these lines are pointed down. So right here, we would take a short or a sell trade at the end of that candle, right? So from right there, why? Because a red ends at the bottom, right? A green ends at the top. That's why we measured from here up, and from here, we'll measure either up or down, in this case down, because that's the end of that candle where we would have entered, okay? And we'll do the same thing, 5 pips, so 1.20696, 1.20646. Ooh, almost right on it. 646. And then our stop loss would be 1.20796. $1.20796. Make that one red. Okay. So again, we just want to go down to that blue line before we go up to that red line. Much cleaner on that one. That one went 10.4 pips, only went up about 1.1 pips. So that one would have been just fine. All right. I want you guys to get loud here. I'm going to click forward. And I want you guys to tell me when you see two things. I want to see when that green crosses the red on top, and all four of these lines are pointed up at the same time. In other words, if green crosses on top on this candle, and then we go to the next candle, and then these are pointed up, that doesn't count. We want to see when green is on top, these are already pointed up. Okay? So unmute and get ready to tell me when to stop. I'm going to click forward. Okay? So just tell me when to stop clicking. I'm going to try to go as slow as possible. Okay. So we're waiting for that green to cross on top. And just tell me when to stop clicking. Any takers?
Stop.
All right. Good. So, good. Who's that? Marina?
Yes.
Okay, I'm looking at the screen over here. Okay, Marina, Tim, Cobes, let's get Marina's information. Let's send her a coin. Silver's up right now. I think it's like what is it? 25 bucks a troy ounce. So this silver coin right here is worth 25 bucks. More of a keepsake. I'll tell you guys really quickly. Marina, I'm gonna give this to you, and I can't remember the other gentleman. Tim's got his information. We're gonna give one of these two. This right now probably doesn't mean much to you, but what it's worth, right? 25 bucks or whatever it is. For people that in our organization, this is important to them. For some of them, it's kind of their totem. This tells them this is the moment where things changed for me. My financial trajectory changed. They carry them with them everywhere they go. They always got them in their pocket. They always show them to people. They're proud of it. This is like a badge of honor for a lot of our members. So, Tim and I were always we used to be really reluctant about giving them away because they mean a whole lot more than their monetary value to a lot of our members. But we conceded by just saying, look, let's just explain to people what they mean to our members. We don't expect that it's going to mean anything to you, and it may not. But we want you to know that this is something that's very important, because when we give it to you, we want you to know that we don't just give it to you lightly, that it's of no consequence to us. It's big deal. It's 25 bucks, right? It is a big deal to us, and we want you to know how important it is to us, and we want to give it to you. But it is important for me, for my students to engage in their educational process. I can lead you to water. I can't make you drink. The more you're engaged, the more you're going to get from it. And I thoroughly appreciate that. So I'm going to give you something that is of more than just monetary value for participating, right? So I appreciate your participation, Marina, and the other gentlemen and everyone that's been participating, asking questions. I appreciate that. I really do. So we're going to send you that coin.
Thank you.
My pleasure. All right. So let's look at this, and so 3 things we want to be able to accomplish when we're showing you a setup. 1, identification, how to identify it. 2, when we would place that trade. And 3, how we would place that trade. Now the how is backtested and so on, but we just made up these parameters, right? So we could give you those parameters to use. So that's the how, 10 pip stop loss, 5 pip take profit. Now let's work on the when we would actually press the button and execute this trade. So let's go to replay, and let's look at this as if we were watching it live. And there's usually a lot we can glean from that process as well. So let's replay it. Okay. So when this candle first started, green's not even on top yet. Majors are up, minors are down, nothing that looks like our square peg, square hole scenario, right? So let's fast forward and see when that pattern actually occurs. Yeah, right there. Green's on top. And all 4 lines are pointed up. So right there is when it occurs, but we still have, because this is a 60-minute setup, we want to wait for the top of the hour. And right now we have 15 minutes and 10 seconds before the top of the hour for this candle. So we're not going to, even though our parameters are there, we wouldn't execute right now. We'd execute in 15 minutes and 10 seconds. I'm going to show you guys something really cool though. So let's get down to 5 minutes. Oh yeah, Alan, I'll show you here in a moment. 9, 8, 7, 6, 5. Okay, right here. So at about 5 minutes, and it's funny you asked that question, Alan. That's like perfect timing. Alan says, "Do these setups happen all the time?" On all time frames. Yes, they do happen all the time. I thought you asked if they happen all the time, and I'll answer both of those. Yes, they happen on all time frames. Obviously, when you backtest a 5 minute, and depending on what time it is, and a 60 minute, you're going to get different results, right? They're not going to be the same. You're going to get a dirty pressure in a 5 minute. Let's say it's a high volume time. Well, maybe you'll get 10 pips, for your take profit, and 10 pips, 5 pips for your stop loss or whatever, right? In a low volume time, maybe you'll get 2 pips, 3 pips, and a 5 pip stop loss, or a 2-3 pip stop loss or whatever. And then with a 60 minute, you'll maybe get a 20 or 30 pip take profit, right? Because it's a bigger time frame. So yes, they happen on all time frames, but how you trade them is based on back testing. So it would take you can see this is actually the setup that I was showing you guys for Jordan, which he had about 500, almost 500 examples on a 60-minute chart. So if you took it to a 5 minute, you'll probably have 5 times that amount, right? So you're looking at more like, 2,500 examples. And if it takes 7-8 hours to compile information for 500 examples, then you're talking about, 5 times that amount to test a 5 minute. So we always recommend testing a time frame like a 60-minute time frame first, getting that information, trading on it. So now you're trading on something that's making you profit and moving your account up and to the right, and then take your time testing something that's going to take a lot longer, because as you're trading live with your blueprint, you're blueprinting something else. You're going to build a different kind of house, right? It's with Forex, with futures, with everything. We start people on Forex. Look, the same rules that apply here in Forex apply in futures, right? You're still going to have to use money management, exit strategy. You're still going to have to backtest. All the things that we teach you in Forex is going to apply to the other markets. That doesn't change. But we teach you Forex because that is going to allow for you to have more opportunity to practice. And you're practicing the same disciplines that you'll be able to use in other markets. If you're asking me to teach you, what a point or a pip is, or, what stocks to trade, how the S&P works, that stuff you can go and look up and Google. I want to teach you guys how to day trade. I don't want to spend too much time on what a pip is, or what a tick is, or what the S&P 500 stands for. You can go find that out for yourself, and I would encourage you to do so. But I want to get to the meat and potatoes, which is backtesting. And to backtest, you have to learn a setup, and then learn a setup, and then money management. I want to give you guys tools and resources and thought that you guys can go out into the world, even if it's not with us, and go and find something that works for you, and be able to articulate what you're looking for, and know if they're selling you a load of garbage. Now, if there were a lot of people that had legitimate companies, I may not do that. That may be detrimental to my business, right? Because you would find something else. But it's so difficult to find an organization that is legit, right? And you guys, I want you guys to go out and look and ask those questions, and you'll see right through their garbage. You'll know how to look at it mathematically now, and you'll know that's not going to work, right? So you're going to see that, and you're going to realize, well, I already know where something works, and you're going to come back. It happens all the time. That's why we're confident in doing it. I want you to go and look at other stuff, because everything I said today, you're going to realize is true. But right now, I wouldn't believe me. I don't expect for you to believe me. My thoughts in my brain are doctrine, right? That's what I believe, right? And so if somebody just says it to me, it may sound good, may look good, I may want to even believe it, but it doesn't make it true. So I want to find out if it's true, Well, now you guys have the ability to do that. And you can see it's not my opinion. Risk reward, money management, backtesting, all those things. How else would you figure out those numbers? And it can't be an aggregate, right? You have those things now. You'll be able to question other people, other setups, and know how to come to an answer as to whether or not it's legit. Do we fund Forex traders? Only ones that go through our program. 95% of individuals fail. Alan, and I'm not meaning to be rude or anything, but you're here because you haven't made day trading succeed.
No.
Yeah. No, and sometimes people take that as rude. Yes, we absolutely fund Forex traders.
I'm sorry to interrupt. I was asking if we go through your program, if that's how it works. That's all I
Oh,
was
yes.
That's all I
Thank
was
you.
asking.
Thanks, Alan. I appreciate the clarification. Yes, everyone that goes through our program, through our coaching program, so we vet people first. You go through our trial, and if you're a good fit, then it's like college, right? You have to be accepted to college. That's what this is. You have to be accepted to the program. And it's not like it's difficult to be accepted. It's just some people are teachable and show up, right? Or communicate otherwise. And other people aren't. They're not teachable, or they don't show up, or they don't communicate. We can only teach people that are teachable and that show up to be taught. It's not that it's difficult. It's not you don't have to be born with something. We just want to make sure that we're going to be able to teach you. And then everyone that goes through our coaching programs, after the Trader Light program, you get accepted, you go into the coaching program. 100% of the time you get a funded account. Guaranteed, you're going to get a funded account. And we don't throttle you. It's not like you have to qualify. No, you're going to get one. And we're not going to say, oh, you can only trade this much, or none of that. You can trade it at, whatever you're going to do. Obviously, you're going to want to do it the right way so you can make money, right? And you're going to want to do it the way that we taught you because it's going to make you money. But if you draw that account down by 50%, so let's say you're trading, $50,000 of our money, and you draw it down to 20, you lost $25,000. That we would stop you there, and we would say, okay, let's take you back, retrain you before you go back into the live market, right? But we're not going to go and try to collect that $25,000 from you. We just chalk it up as a loss. The only way we can do that is if our traders are successful with our money, right? Otherwise, we'd be giving traders money and they'd be losing it. And then how does that make sense as a business? It does not make sense as a business. So we don't do that. We make sure to vet people as best as we can. Now, guess what? Even after all that vetting, even after feeling good about you guys being a good fit for us, obviously the person feeling good about us being a good fit for them, or you feeling like we're a good fit for you, we still have people that it doesn't work out for. It doesn't work out for everyone. Now, the only way you can figure out if it's going to work out for you is by trying it first. That's why we have our trial, our 30-day trial. So you can ask yourself, can I do this? Is it valuable? Does it meet a personal need? That's what we want you to be able to evaluate. Can you do these things? Is it valuable? Does it meet a personal need? If the answer to any one of those is no, then it's not the right fit. And you should tell us it's not the right fit and move on. And that's okay. We're not going to be mad. That's great. Thank you for letting us know that we didn't waste our time or money or effort on the wrong fit. We wish you the best, right? We've had friends, by the way, that we've said no to, people that know us, because quite frankly, those are the people that are like, it's my friend. I'm not going to show up to that appointment. Or no, I wiped his butt when he was a kid. Why should I take any advice from him, right? So it's like, it's not going to work for you if I bring you into the organization. Why would I do that? It's not going to work. I couldn't give this to you for free. It wouldn't work because you're not going to do what is necessary, right? And we've been doing this for a long time. We're pretty good at figuring out the right fit. Okay, so let's continue with this right here, by the way, and thank you for those questions, Alan. Right here, we have 5 minutes and 6 seconds. Check this out. Here's what happens in about 5 minutes. All the parameters are there at 5 minutes. That automatically triggers an alert. An alert will go out. So right here, this is just yesterday, which is Friday. Fridays are usually slow days in the market. Dirty pressure, what I'm showing you right now. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 times. It happened yesterday in a actually less than 24-hour period, because Friday, so Thursday at midnight, so that's the beginning of Friday, until 5 p.m. Eastern. So that's normally those are running a 24-hour period, right? So midnight to midnight, but the market closes at 5 p.m. Eastern on Friday. And we got 14 setups from midnight to 5 p.m. So that's 17 out of 17 hours. Out of 17 hours, we got 14 setups for just this one setup. We have tons. We have over 30 patterns, guys. And some of our traders will trade exclusively on patterns, one or two of them, some multiple of them. Others will just use discretion because they've been around long enough that they can just read the indicators. They don't need a pattern. They don't need to wait for the top of the hour. It's different for them, right? But we could show you, how long did it show me how long did it take me to show you this, Marina? And then you were like, yeah, there it is. There's green on top. All four lines are pointed up, because it's a square peg, square hole scenario. It doesn't take, you could not know what a pip is at this point and just know how to put it in a trade and set a stop loss and take profit. That's it. And if all you know is to do that, I can teach you how to back test, and you don't have to know what the Forex market means. You don't have to know what the futures market means. You don't have to know what a pip stands for. You don't have to know what the FOMC is or the ECB. You don't have to know what rate increases are. You don't have to know any of that garbage. You don't have to know what support, resistance, trend, channeling, any of that stuff is. All you need to know how to do is have your setup, back test it, and execute it, right? As long as it fits your risk appetite, your personality. That's it. Everything else you can learn along the way, right? So what do we say? What things do you want to learn? And let me tell you, this stuff is hard. The stuff that I want to teach you that you need to know, right, to be successful as a day trader is boring. You guys want to see this stuff. I wanted to see this stuff. I want to see how you can place a trade. I want to see how these lines work. I want to learn that stuff, right? You don't want to build a foundation. You want to drive the tractor. I want to drive the tractor, but sometimes you got a blueprint and it's boring, right? It's just lines on a piece of paper. When do I get to drive the tractor? The tractor is just the tool. I need to learn how to build the house first, right? And then I can learn how to drive the tractor. This is the tractor, and it's great. It's better than a shovel, right? But back testing all that boring stuff, that's day trading. The boring stuff is day trading. The rest is just executing. These are just the tools, right? But everybody wants to sell you their tool. They want to sell you the fancy, shiny tractor because that's what gets our attention. And they sell it to you, and you realize, well, great, I got a tractor, but I don't know how to build a house. But you don't realize that until you try to build a house and it falls apart and you lose all that money. And you realize, man, I was over here focusing on a tractor, and I don't even know how to build a house. What do I need a tractor for? Right? Okay. So right there, you get an alert. Okay, by the way, these come 5 minutes before the top of the hour. If I'm using, so they're always alerted on a 60-minute. We don't send out alerts for any other time frame because that would be insane. On a 5-minute chart, if I'm getting 15 of these a day on a 60-minute chart, a 5-minute chart would be 10 times that amount on 6 different currency pairs, maybe 100 times that amount. You would just shut off the alerts. It wouldn't even be useful. It would just be going off way too often, right? So 60 minutes is where we're going to send out the alerts. All of our members have access to our alerts as well. And on the trial, you would have access to the alerts and the indicators and all, and we'll go over that in a moment as well. Okay, so right here, we get an alert. We're in the grocery store, right? We're wherever we are. We're on the beach. We're watching television, whatever we might be doing at that moment, and we get an alert. Dirty pressure, Euro USD. Okay, we look at our setup. Yep. Green's on top, all 4 lines are pointed up, perfect. In 5 minutes, I'm gonna press the buy button based on my back testing. I'm gonna use a 5-pip take profit, 10-pip stop loss, and I win this, whatever, 75%, 80% of the time, 90, whatever it might be, right? I'm gonna use 2% risk, and my account is this much, so I'm gonna use this lot size, 1 point, whatever it might be, 1.0 lot size, right? Because I already have my blueprint. I already have the answers to these. I don't have to figure that out right then. I already know the answers to all that stuff. Now all I'm doing is doing whatever it is that I want to do in life. And then when that notification comes in, I say, okay, I'm ready to, I tested for this time, and now I'm getting notified. I don't have to sit around waiting for it to happen. I get told when it's happening. Now I can just jump in. This is 2021, ladies and gentlemen, right? We got technology. Let's use it. Let me free up some time for you, right? Okay. So we get the notification. Now we're just waiting 5 minutes. We got 1 minute and 5 seconds right here. So when it gets close enough, let me just bring up so you guys can see what this would look like. Oh, goodness. Now it wants to update? You kidding me? Okay. Well, we'll let that update. Okay. So we have 45 seconds. And in 40 seconds, so we already have our finger on the trigger. We've already known for 5 minutes, right? So we're not, it's just not knee-jerk reaction. We're not like, oh my God, I got to get in really quickly. I only have a split second to make my decision. No, you've already made your decision and you had 5 minutes to sit there and contemplate it or slurp on a Slurpee. I don't know, whatever. Now all you're doing is if you're using MetaTrader 4, for example, all you're really doing at that point is just waiting for that 37 seconds to expire and then pressing this buy button. So you're sitting here like this, waiting for that with your finger on this button right here. And then as soon as that 37 seconds is done, as long as those parameters are still there, you press the buy button. And then you can go in here and set your stop loss and take profit, right? So here we go. 36, 35. Plus we have things that scripts that you can push one button, it puts you into your trade, sets your stop loss and take profit, and figures out, you can pre-program it to say how much you're going to risk on that trade. And it'll just, you push one button, it puts everything in for you and the correct lot size. And I'm telling you, you can't make it any easier, right? I can lead the horse to water and I can splash the water in your face as your mouth is open, but I still can't make you drink. I can make it really, really easy, right? I can even strike you in the throat to hopefully that you drink, right? That's what I'm doing. I'm leading you to water. I'm waiting till your mouth is open. I'm splashing the water in your mouth and I'm karate chopping your throat to hope and plugging your nose, hoping that you'll swallow. But I can't make you swallow. I can only lead you to water. I can't make you drink it. But I can make it really easy. Or simple, I should say, right? Okay, 8 seconds. So I wouldn't be drawing a line. I'd be pressing that button that I was just showing you, right? But here I'm just going to show you, boom, push that button. So that's where I would enter, 1.20538, right? And we're going to take 5 pips for profit. Oh, check this out though. This is interesting. Notice when this new candle came out, that's not pointed up anymore. That's pointed down. The green popped on top back here. But we're not looking at how this one is forming. We're not looking at how this candle is forming. We're looking at how this candle formed and finished, right? Again, we don't need an indicator to tell us that it's going up or it's going down. We need an indicator that tells us it's going to go up or it's going to go down, but also be accurate. So I'm not looking at what it's currently doing. I'm looking at how it already formed, and now I've already made my decision. So this does not fit the criteria because we're not looking at that. We're looking at the last couple seconds of that one, and that fit the criteria, and now we're in the trade, okay? All right, so 1.20538, 1.20588 would be our take profit. 588. And our stop loss would be 1.20438. 438. I'll make that one red. Okay, let's play this out, see how it goes. So we're in that trade. I'm going to fast forward this. All right, a little bit up, a little bit down. This is at 250 times the speed. This is probably a slow time in the market. Oh, there we go. Good. Look at that. Nice job, Marina. You called that long trade? We got it. All right, let's do another one. Speed that up. Oh, shoot. I should have went back first before I sped it up. Okay. Okay, good. All right, let's do another one. Now that green is on top, we want to see when it crosses on bottom of red, and all 4 lines are then pointed down at the same time, okay? So first thing we want to see is that cross, and then when we see that cross, then we look up, okay, are those lines pointed down? We want, just think about it this way. Green on bottom, when we think bottom, we think down, so we want these lines to point down. Green top, we think up, so we want those lines pointed up. So just remember that, okay? All right, I'm going to click forward. Let me know when to stop. All right, and anyone can shout this out. Don't be shy. Okay. So that one, we already did that one, so we're not doing that one. We're waiting for it to cross on bottom now.
Stop.
Good. Okay, let's look at it. All right. Okay, yep. Okay, so we got green on bottom. What else do we need after green's on bottom?
The ones on top have to be going facing down.
Facing down, perfect. And they are. Awesome. So which direction do we trade this? Do we buy or sell?
Sell.
Perfect. How many pips are we going to go for?
Oh,
Which one of these numbers?
10.
5.
Oh,
So,
yep, 5 and then 10.
yeah, good. Risk, remember, it's risk to reward. So it's risk is 10, 5 is reward.
Gotcha.
All right, good. Awesome. Okay. So right there at once that candle ends, we press that sell button, and then we put in our take profit 1.20592. So we're going to go to 1.20552. 555955. Yeah, 552. Oh, got it right on it. Okay. And 1.20692 will be our stop loss, right? So 1.20692. And make that one red. Okay. Let's go forward. Yes, money. All right. So it went up 4.2 pips, but didn't stop out and then came back and would have crossed that line. Man, all the ones that we've done have gone more than double what we're looking for, but we like these parameters because it gives it room to kind of move around. So 14.7, that's good. Good. All right, no help this time. You guys let me know when you see the next one. I'm not going to give you any help. You need to figure out where you want that line, and don't be shy. Even if you don't get it correct, doesn't mean that, you know, it's just part of the process, right? So don't feel like you can't say it because you're not sure. Just say it. Okay, I'm going to click forward. Tell me when you guys see something. Good. All right. So there's, I stopped there for a second, see if anybody would bite, but you didn't. So that's good. Green is on top, but these lines are pointed down. So that's not the setup. Even if on the next candle, those point up, that would not be the setup because we want to see the moment that that line crosses above, that these are already pointed up and they're not. So no go. Well, looking at this from a discretionary point of view, not a systematic, right? We're looking for a square peg, square hole scenario. There's a lot of reasons why our traders would sell on something like this. We have TNTs giving us at a 3 out of 4, majors pivoted in the channel, and pressure long-term bias to the short side. So there's a lot of reasons why we would sell there, but what you guys don't know about any of that, right? So what you know is a pattern, a square peg, square hole scenario, which, by the way, not only could I teach to a 5th grader and have them do it, I have and we do. So it's that simple, right? Okay. So nothing there. We wouldn't do anything there based on our dirty pressure setup. Okay, let me know when you see another one. Here's another, this is not one, right? So good, I'm glad nobody said anything. Green did cross on bottom, but one of these is pointed up, the other one's pointed down. So no square peg, square hole scenario. We'll skip past that one too. Okay, let's keep going. Let me know when you guys see something. No takers? All right.
I'll take it.
All right. So you got green on top and all four pointed up. So green pressure just crossed on top. All four lines are pointed up. So we take a buy right here and we would look for that 5 pip, right? So click forward, or let's draw the lines. So that would be our entry right there, 1.20226. Our take profit would be 1.20276. And our stop loss would be 1.20126. Okay, we want it to go to that blue line before it goes to that red line. Next candle, boom, money. There it goes, 12.1 pips up, 2.7. So what are we showing you here, right? Because I'm telling you, well, I can't tell you the stop loss and take profit. Is it going the direction that we say it's going to go? Yes, right? Now, this is probably not very fair because normally by now we've seen at least one loser. We haven't seen any losers, but that doesn't mean it doesn't lose. They lose. They're just really accurate, right? They will lose, and you have to know when and how so that you can account for that. Because even if you win 99% of your trades, it doesn't mean you're making profit. So you need to know where those are going to happen for you and how, based specifically on the times that you're available to trade, right? This is not my opinion, guys. This is, if you don't do these things, you won't be successful as a day trader. Problem is, you may not figure that out for a long time, and you may have lost a lot of money in the market in the process. I'm trying to help you out here. You got to know this stuff. Okay, so that's our dirty pressure setup. That one happens really, really often. Just to give you an idea, if you had, so I want to just break this down for you. Now, of course, we don't make any income claims. We stay away from all of that. We're not going to sit here and say, all of our members do this great, wonderful things, because really, ultimately, why would that even matter to you, right? Just because thousands of traders can do it doesn't mean you can, right? Even if millions and billions and trillions can, doesn't mean you can, right? I'm not going to go and try to, win a foot race between me and Usain Bolt, right? He's one of the fastest men in the world, not the fastest man in the world. I know that I'm not going to do that. I'm not going to try to go and play for the NFL, right? I know that I'm not built for that. Okay. But let's say that somebody came to me and I didn't know anything about the NFL. And all they told me was, you could play this game and you can make millions of dollars, right? Is that true? Yes. That people play that game and they make millions of dollars. Okay. And I'm going to teach you, you can pay me and I'll teach you the rules to this game, and you'll play it and you'll be able to potentially make millions of dollars. And I say, well, show me somebody that's made millions of dollars playing this game. And he starts showing me hundreds of players that make millions of dollars. Could you, knowing nothing right now, obviously you know about football, so could you right now Google football and find a whole bunch of players that make hundreds of players that make millions of dollars playing football? Yep, you could, right? Okay, does that mean I can make millions of dollars playing football? Nope, does not, right? Okay, so if I try to do the same thing and we had that exchange, and I said, you can make all this money day trading. Well, you already know that. That's why you're here, right? And then you say, well, show me some people that have. Believe me, I can. And if you insist, I will, right? Not now. You'd have to, because we don't even know if you're a good fit. Right? And I can't tell them what to say. I'll just push them to you, right? And I have people like that will do that because people do insist. They want to talk to a live person that's a real person that has gone through the program that does not work for us. Our traders don't work for us. We have an agreement. They trade our money and they trade their own money, and they sometimes don't trade our money and just trade their own money or just trade our money, whatever they want. It's up to you, right? But I could show you those people, but just because those people can do it doesn't mean that you can do it, right? Just because someone else can do something doesn't mean that you can do something. Even if thousands of people can do it, right? Doesn't mean that you can do it. So how do you figure out if you can do it? You got to try it out. You got to try it out. That's it. Can you do it? Is it valuable? Doesn't mean a personal need. We're not just making this stuff up, guys. This is not some kind of, I don't know what you want to call it, some kind of crafty sales pitch. This is just how we get down. Do we want people to come into our organization? Absolutely. We get them to come into our organization all the time, and it's wonderful. But it's not. We don't have an open door policy. Not everyone's allowed. It's not because we don't like you or we're discriminating. We just want to make sure that when you come to our house, you're a student and you're willing to learn. I'll tell you right now, if you're a day trader, I'll tell you what I tell every and this is fact. And my people tell every day trader that have day traded before us. If you are unwilling to forget everything you know, if at some point we ask you to forget everything you know, we may or may not, but if at some point we ask you to forget everything you know about day trading and allow for us to retrain you, if you're not willing to do that, it's not a good fit, and we don't want to do business with you. Flat out. So if you're that person, if you feel like you've got some things figured out, it's probably those things that are causing for you to be unsuccessful at day trading. And if I am not able, if my team, if at some point we can't come to you and say, hey, those things, they're not going to work for you, you have to let them go. If you don't feel like you would be willing to let those go, and you may never be asked that, by the way, but I don't know. So I'm going to just put it forward. I've always put it forward up front. If you're not willing to let some of those things go and willing and allow us to retrain you from scratch, you're in the wrong place. I'm sure if we met on the street in different situations, we'd probably get along just fine. I get along with everyone. I'm the hardest person to offend. I get along with everyone, but I don't want to do business with you. And you won't be allowed into the program because I can't help you. And if I can't help you, why do you want to be here? And if I can't help you, why do I want you to be here? Right? You see how that works? It's nothing personal. So consider that if you are an existing trader and you're here, or you're listening to this after the fact, or whatever it might be, if you feel like you have something and you just need a little tweak in it to then become better or whatever, and you would be unwilling to let that go if we asked you to, go somewhere else. I can't teach you anything. Because in my experience, it's that thing that's stopping you from being successful, right? You did so. What did we talk about before? Rewarding yourself for pissing on the carpet. You did something that you shouldn't have done and it worked out really well. And now you're convinced that that works really well, but there's other things within that you're not sure of, or you need to tweak out so that one thing that works really well for you is going to now work all the time. And it's that thing, getting to that thing, and the practice, the negative, the bad practice that you implemented to get that bad thing, that also makes you lose all of that and not be able to be a professional day trader long term. So again, if the idea is just to hit a big one, right, hit one good big trade and be done, then odds are against you that you'll get that, right? You'll probably lose all your money first. But if that's the idea, well, this is not the place for you either. There is no place for you. Just go to Vegas, throw it on red, on a roulette table, and hope for the best. And if you lose all of it, well, you're just as likely to lose it in the forex market or futures market or day trading market. Either way, right? So if you're serious about day trading and serious about your financial trajectory, you've got to do the things that are necessary to be successful. So I'm not going to sugarcoat it. I could have cut out 3/4 of this seminar and taught you and fanfared and showed you all the exciting stuff for half the time, but even took 6 hours and showed you nothing but exciting, hard-hitting, impactful things. And I could have built this whole presentation around garbage just like everyone else does, and I would get probably more people than I do now. But I don't need more people. I just need the right people. That's it. I just need the right people. I don't need a whole bunch of people. I just need the right people. All right. So let's see. Let's move on. I'm going to show you guys the Trader Light trial, and we're going to wrap up, okay? Because I want to leave some time for questions. So let's go to our slides. Okay. I had some other things in here that we could have gone over, but I wanted to just kind of gauge it, see what kind of time we're running on. So duckbill is another one we were going to show you. Okay, I already talked to you guys about the alerts. These come in 5 minutes at the top of the hour, and they come in all day. I mean, 20 to 30 of them a day, every day, Sunday through Friday, which is when the Forex market is open. We only send out alerts for Forex trades, and a lot of that is due to regulation, right? There are rules that you might find that people break, and maybe you don't know that they're breaking them, making income claims, you know, taking live trades with non-members, all kinds of stuff. If it's illegal, we don't do it. If it's against the FTC, SEC regulations, we don't do it. We don't get close to it. We don't dabble in it. We don't dip our toe. We stay away from it. This is our baby. This organization, this company, our members is our baby. And so we do things right here. So we only alert for Forex because there's no regulation against that. Let's see. Okay. So day trading or corporate funds, we put our money where our mouth is. We are so confident in our program that we will stake you while you grow your financial future. You keep the lion's share of the profit. Upon completion of coaching, students are guaranteed a funded trading account, right? So this is great. This is awesome. It's one of the highlights of our program. But the vetting process comes first. So let's talk about that. Trader Light trial. It includes 30-day trial. You're going to get our indicators, right? So the major, minor, pressure, TNT that we were just showing you. You're going to get a demo account so you can actually place those trades that you see in this with the lines like we were looking at. Instead of just drawing the lines on the screen, you're actually going to press the buy and sell button in the live market with the live quotes with paper money, right? We don't want you to risk real money, right? But you'll get that experience of how to do that, learn how to count pips, all that good stuff, right? On-demand library of training videos. So this is stuff that you can watch whenever you want, right? There's tons of it, and you'll learn a whole bunch of stuff. Matter of fact, you'll learn more from this 30-day trial than you will with most things, and it's more direct, and it's got intention. So you're not just kind of floundering and looking left to right and piecemeal things together, right? So that on-demand library of training videos, daily live trade webinars. So you would be a Trial Light member, so we can take live trades with you. You would have the ability to log in to a webinar with one of our coaches that's taking live trades in the live market. You can take those trades with them in your demo account, right? While that session is going on, and that's on a daily. Matter of fact, we have more webinars in the week than we have days in the week, right? And that's every day. So today there was a webinar this morning. Tomorrow there will be a webinar in the evening. On Monday there'll be 3 or 4. Tuesday 3 or 4. So on and so forth. Every day, 7 days a week, we have at least one webinar. And out of those webinars, most of them are live trades that we take with our members. Okay, the others are furthering education, things like that. So you'll have access to the daily, some of those daily live trade webinars. Not all of them, but some of them. It'll give you enough to have at least one every day. But some of those days more than one. 3, check this out. 3 one-on-one training sessions with the pro day trader. You are going to have one-on-one sessions with a pro day trader, quite possibly myself or my business partner, Tim Kovlin, if not one of our other people. But we like to be engaged with our members, like we said. You're going to get 3 of those one-on-one training sessions with a pro day trader. Software setup, so we're going to onboard, make sure we get all the software set up for you, show you what it is, how to access it. Real-time alerts, All the alerts that we're showing you, you're going to have access to those. Plus all that on-demand library is going to show you all the patterns that we have, explain to you the setups. We've got flashcards so that you can have visual aid, so you can learn how to, you'll have videos explaining how to use the alerts and how to place trades. You name it, right? It's going to be within this Trader Lite trial. Regular price, $7.75. Obviously, you guys know if I'm saying regular price, that's not what we're going to charge you today. $10. $10 for a 30-day trial. You couldn't pay someone $10 for even 10 minutes of a one-on-one training session. You're going to get 3. Just that alone right there is worth more than $7.75, by the way. $10. $10. Here's how you're going to do it. Let me put this link in. And if you guys have questions about this, you want to speak to someone directly, we've got some people that you can talk to right now. Otherwise, I'm just going to give you this link, and you either sign up or you don't. Either way is totally fine. I don't need an explanation, nor should you have to give one. Let me send this to the whole group. I'm putting a link in the description, or rather in the chat. You click on that. When you click on that, use promo code, and you'll know that you'll want to use a promo code when you see the price. Cobes, what is it? Save 485, SAVE 485. Okay, just like
Yes,
that, lowercase.
lowercase.
Okay, lowercase and all together, right?
Right.
Okay, there you go. So use the promo code save 485. So the site looks like this. And by the way, that $10 is going to St. Jude's Children's Research Hospital. So we're not keeping that.
The save 485 doesn't work. Don't mean to interrupt. I hit apply, it don't work.
Let's see. 45. Yeah, it works for me. What the heck? So go traderlite.com.
I got it. I think I got it.
Okay. Thanks, Alan.
I think
Now
it's stupid.
that $10 that you guys pay today, none of it goes to us. We're sending to St. Jude's Children's Research Hospital. You guys can donate more if you'd like. That's entirely up to you. And we're going to give the $10 that you sign up for today to St. Jude's.
One more question real quick.
Yes.
I'm getting my new laptop tomorrow. Should I just sign up tomorrow or should I just do it now? Because I know I can't put the software on the one I have now.
Yeah, onboardings won't be scheduled until Monday. My team is not working tomorrow, and we'll be making calls for anyone that signs up this weekend on Monday. So you're good. You'll be just fine.
All right.
Don't drink it.
Onboardings is where we connect with you via screen share and get everything set up on your computer. So we set up the indicators, set up the demo accounts, make sure everything's working correctly, make sure you have access to the sites that you need to, and then we schedule your first one-on-one session. So those we'll be making those calls on Monday. So there you go, guys. That is the offer to come out and see if we're a good fit for you, and if you're a good fit for us, and give both of us, both you and us, an opportunity to evaluate if we have a good fit, right? We don't do the high pressure sale thing. It's not how we get down. So that is our proposition. We know that we got a great program. You may or may not think that we have one yet. The best way to find out is to check it out. Knowing now what you know, right, on how to vet an organization, how to vet what somebody is saying, you are more equipped than most people in the industry to vet not only us, but anyone. You may be using somebody right now and had that epiphany like, oh, wow, I should ask those questions, or they didn't really show me that, right? I can over 95% of the time, I'm right. So if I'm taking a guess, if you've even looked into anything else, it's garbage. And over 95% of the time, I'll be right. I'm not saying I'm the only show in town, but I'm saying statistically, I am right.
Just want to let you
Fortunately-
know that I'm in. I already did it. So I guess I'll be getting a call from you guys on Monday.
Awesome, Alan. All right, we look forward to talking with you then. This is Alan, right?
Yeah, it is.
Okay, I see the orange, the yellow box surrounding a name, so I just I just assume. All right, thank you, and we'll look forward to talking with you on Monday, Alan. Awesome.
Okay, thanks. All right.
Hey, Hiram,
Yes.
I just wanted to let Marina and Peter, I put in our email, info@daytradesmart.com.
Okay.
If you could send us a physical address so we can send you those coins.
Yes,
That'd be
so
great.
don't put that in the, thank you, Tim. Don't put that information in the chat, please, Marina and the other, who was the other one, Tim? Peter?
How do,
Peter, yeah.
Okay, so don't put that information in the chat, Marina, Peter. Make sure you either email it, or if you're uncomfortable providing it, don't provide it at all, but we don't want you to put that in the chat. It's sensitive information.
how
Alan,
come
you
I
had a
didn't get
question?
coin? Yeah, how come I didn't get a coin?
You know what? You signed up. You were the first one to sign up, I think, so we'll send you a coin.
I was just joking, but thank you. It was just a joke.
No, hey,
But
you know what?
thank
I got no problem with it. That's and I appreciate you being bold enough to ask for it.
All right,
All right.
thanks.
Hey, it's
I'm
been
gonna
my
leave the
pleasure.
phone now. I gotta go out. I'll talk to you guys on Monday.
See you, Alan. Thanks. All right, guys. Thanks for joining us. If you guys have any questions or feel like you need to have a more intimate conversation about any of these details or what have you, feel free to reach out to us, info@daytradesmart.com, or feel free to call us 801-701-8875. If you guys have not already, go ahead and go to youtube.com/theprovingground and subscribe. That way, when we post this video and other content, you'll have access to that as well. And of course, that is free. That is absolutely free. And you can continue to watch, a lot of the content that is there indefinitely. And again, thank you for joining us. And I'm gonna give you guys just a few minutes. If you guys have questions, feel free to ask those questions. We'll hang out. Otherwise, we're all wrapped up for the day, and you guys have a happy Saturday and happy weekend. And we'll look forward to working with those that decide to try out the Trader Light trial. And the rest of you, happy trading. Thanks.